Hello everyone. In this lesson, we are going to do MCQs on statement of changes in owner's equity, as well as some limitations of financial statements. Let us go ahead and try and do them. Hello everyone. So please pause it. In this lesson, try to answer it yourself. These are all level A statement of changes in owner's equity, as well as some gives you a concept of financial statements. So let us go ahead, do and try all these questions. Which of the following is the best definition? Please pause it. In this lesson, try to answer it yourself. These are all level A statements, so quite easy. Equity, all financial as well as some gives you a concept of financial statements. So what exactly is the going concern? All these questions. Is it that the entity will continue in existence? Which of the following is the best? Please pause it. In this lesson, try to answer it yourself. These are all level A statements, so quite easy. All financial as well as that gives you a concept of made profits. So what exactly is the going concern? All these questions. All firms do not have to make profit. Which of the following is the best? Please pause it. In this lesson, try to answer it yourself. These are all level A statements, so quite easy. All financial as well as that gives you a concept of made profits. Hello friends, welcome to the class on integrated reporting. So in this lesson, it's a recently added lesson, so it's effective, I think, from 2020. So in this lesson, we are going to look at total different type of reporting. It's a recent development. Let's go to the text and I will tell you the highlights of this lesson. So integrated reporting, as I told you, it is the latest recent development. It's been around from 1999, but the International Integrated Reporting Council, the IIRC, got it copyrighted in 2013, and they are trying to implement it in corporates ever since. So what is it all about? Basically, I'll just highlight what it is about. An integrated report, so that you don't read the entire text, you don't have to read it. I'm just going to highlight it. Of course, if you want a deeper reading, you can go through it. So an integrated report incorporates non-financial along with financial reporting. Okay, so it's also non-financial information along with the financial information provided in financial reports. So, and how the financial information is influenced by non-financial information over the short, medium, and long term. See, there is a connection between non-financial information and financial information, right? So, and in order to be sustainable, now this is the purpose of integrated reporting, sustainability. In order to be sustainable, the reporting, the non-financial numbers also are necessary. So why should we, what is non-financial information and why report it? You see, it has come to a notice that public, that some corporations, the general public has come to know that some corporations are prospering at the expense of broader community. To give you some examples, like, in 1993, the Pacific Gas and Electric case, wherein they contaminated the water, drinking water with hexavalent chromium, right? You must have seen the movie Erin Brockovich, where she became the whistleblower against PG&E and won the largest legal settlement of $333 million Yeah, so if you look at the movie, they give you all the details about it, and it's quite true also. So the people suffered. Many people died. They got cancer and things like that because of this contamination. And the corporate was prospering. Okay, and no reporting was done to what they are doing to the capitals, what they're using. Water is one of those capitals. So that's what we will study later on. And then in India in 1984, there was a Union Carbide India Limited Bhopal gas tragedy. So this company, Union Carbide India, caused a gas leak of methyl isocyanate, which was a very poisonous gas. It happened in the midnight, and many individuals, as many as 40,000 individuals uh, were permanently disabled or suffered a serious illness, right? So this careless attitude and lack of stewardship of the corporates on what they are doing to the environment caused this kind of reporting to come out. However, very strangely, this is not yet mandatory. So corporates need not actually do this reporting, but a corporate which does this reporting, it would improve its image in the society because it would show that it is caring for sustainable development. You can be sustainable, a corporate can be sustainable provided it looks after it's concerned about the broader community. So the movement started somewhere in 2000, they say, so by a body called a non-government organization, an NGO called Global Reporting Initiative. Okay, and then there have been many amendments later on, right? So these people brought about what you call, it has become an international standard. GRI framework has become an international standard for reporting on environmental and social responsibility, including sustainability and economic performance. See, along with what I would like to show you here is what does this come to boil down to? Because how the organization's responsibility contributes to sustainable development, including health and welfare of the society, not just making money. Of course, shareholders' expectations are not to be ignored. Until now, most of the companies are only concerned about the shareholders or investors' expectation, but they should look at the health and welfare of the society. Only then they can be sustainable. They can survive in the long run, and they have to comply with all the kinds of laws and with international norms of behavior, and is integrated throughout the organization and practiced in its relationships. So that is the main aim of it. So now the main thing, now let us, you can do all this reading to know more about it, but I'll come to the main point of it. Okay. So the mission is to have integrated reporting and thinking. That means think more than financial, right? To integrated is, what is the meaning, dictionary meaning of integrated is cohesive or whole, right? Not one, but more than one joined together. So that kind of things. So that is nothing but non-financial and financial, right? Their mission is to bring reporting, integrated reporting and thinking into mainstream business and make it a norm, right? And the objective is to change the corporate reporting system so that integrated reporting becomes the global norm. It has not yet become a global norm because it is not mandatory. Okay, so but still that is the objective of the International Integrated Reporting Council, IIRC. Now, so basically, they are talking about integrated thinking and integrated reporting, about value creation over time by incorporating integrated thinking. Value creation founded on integrated thinking. I'll come to a moment and explain to you what is actually integrated thinking. The capitals. Now, before looking at the capitals individually, let us look at this diagram which says it all. So when you want to revise, in other words, just have a look at this diagram. This is the main thing. Okay. So integrated reporting and integrated thinking is not only thinking financial, but it is thinking about the manufactured capital. These are the 6 capitals. These are the things you have to memorize. This is the main thing about this chapter or this lesson. These 6 capitals, right? Not only financial. So financial is what? It is nothing but equity and debt, right? Manufactured is the capital which organization uses, like, for example, building and equipment, bridges, roads, etc., which it uses. See, it's all in relation also to the external environment, not only internal, right? So it would use the bridges, roads, etc., right? So that also would be taken into consideration. Intellectuals. Now, what is intellectuals? The patents, copyrights, etc., that it uses or develops. Okay. Human would be the human talents which it uses for its business. Competencies, and yeah, capabilities, etc. Social and relationships is the values, behavior, okay, as per international norms, and also human rights also would come into this, and also the relationship it develops with the larger community, right? And natural, surely it's using water, it's using maybe it's using some forests, and yeah, even land. So when an organization uses these 6 capitals in its business model to create value, right? So these becomes inputs to its business model, and it goes through its business model of governance, okay, and its strategy and resource allocation, right? Its performance, the risks and opportunities to use this capital, and finally they make profit. So the corporates so far only are worried about this financial output. From a financial input, what is the financial output? Profits. Now they have to be considered. Now integrated thinking forces them to think cohesively about all the capitals, not only the financial part. So manufacture, they use buildings, equipments, roads, bridges, etc. Have they improved that, or has it deteriorated? Intellectuals, they used patents, copyrights, etc. Is there a development in it? Have they found out anything new? Have they enhanced that capital? Not only enhancing financial capital, have they enhanced this capital, intellectual as well, and the manufacture as well? Have they developed human beings? They use their talents and their capabilities and competencies. Have they improved? A plus should be there in everything. There should be a proper quantitative metric to measure all this. Of course, we have financial metrics plenty, but do we have the other metrics? That is another disadvantage about integrated thinking. I wouldn't say disadvantage, I would say challenges for integrated thinking. Okay. Do you have something to measure intellectual capital enhancement or deterioration, human capital or deterioration? Have the relationships improved with the society? Are their values and behavior respected by the community, right? And do the organization respect the values and culture of the society? So all that, there should have been an improvement in relationships as well. And natural capital like water, forest, land. I told you about the PSG case, right? PGE, Pacific Gas and Electric case, where they contaminated the water, and the Bhopal gas tragedy of by Union Carbide Limited, which caused a gas leak, right? So things like that only causes a minus in all this. Okay, so the shareholders, when they see there's been a all around plus in everything, and if these figures are properly audited, again, there is no proper auditing for these kind of metrics, right? So that is another challenge for integrated reporting. So anyways, all this in context with the external environment, there should be a plus in all the capitals. So that's all about integrated reporting, right? So if you study this table, it's sufficient. Now comes the challenge of memorizing these capitals. I bet that if you close it, you might think about only financial capital. So I have found out a memory aid. Let us call it Finish. Finish manufacturing. Okay, so F for financial, I for intellectual, N for natural. Okay, I'll put it here. N for natural, S for social, and H for human. So finish, and you add to that manufactured. So finish manufactured. We can remember it as finished manufacturing. Okay, so this way you'll remember all the capitals. Finish manufacturing. F for financial, I for intellectual, N for natural, S for social, H for human, finish manufacturing, right? And what constitutes this capital? What are the items included under this capital? Do not forget. Manufacturing includes, for example, buildings, what it uses, roads and bridges, right? Equipment, etc. And human is their competencies, talent, capabilities. Natural is water, land, forest, etc. Air even. And all those things, you have to remember what it contains. It goes through the business model, goes through the corporate governance, goes through proper resource allocation, and comes out either enhanced or deteriorated. So the aim should be to report these numbers truly and properly, and include this, and it should become a norm of the annual report, or they can have a separate report on these 6 capitals. So that's about integrated reporting. We'll come to the merits and demerits, or the advantages and benefits and the challenges in the next session. Hello friends, welcome to another session on integrated reporting. In the last session, I spoke about the 6 capitals and what is integrated reporting all about. Now let us study the benefits and challenges in integrated reporting. Let's go to the text. So this is the material on benefits of adopting integrated reporting. What I would suggest is do a reading on this, okay, but I will explain it in a nutshell, right? So instead of going through all the points, what is most important is it brings about discipline in the company's reporting, right? So that part is there. And this is very important. How well it's performing. See, it all material information, that is important. Okay, anything which is material is only reported. And it shows how well it's performing in non-financial areas that affect the company's strategy and execution. And also, it brings about clarity between financial and non-financial performance and how value creation is affected. So now this would bring about sustainability. When a company understands or the stakeholders understand the relationship between financial and the other five types of capital, which is basically non-financial, and how they would affect each other and how value creation is affected. Once they understand that, they would build a model for a sustainable business. So that is the most important thing which you should know here, right? The other things are not very good points. If you go to see like greater employment engagement may or may not result. It depends on the culture of the organization. And this is also very important. Instead of saying integrated reporting can lower an organization's reputational risk, let us look at it in a positive way. It would enhance the reputation of an organization if they are going to report non-financial numbers, and if their impact on those non-financial capitals are positive and enhancing, then the organization's reputation would go up manifold. Okay, so that is the main thing we should know here. The relationship between financial and non-financial information and how value is created, which would bring about sustainability, and integrated reporting would actually enhance the organization's reputation. Then the challenges. The challenges, of course, it requires the support of top management. Right. And first of all, it is not mandatory. So companies may not spend time and resources in reporting it. Right. And then non-financial information does not have the same established reporting standards as financial information. Okay. And quantitative disclosures of non-financial measures would not be measured in monetary units. Okay, and understanding what is material and to be reported to the stakeholders could be challenging because it depends on the industry and from company to company, and it's very subjective, right? And then auditors would find it difficult to give a positive assurance on this information, right? Internal controls of our non-financial data would not be so good, and it would set up a challenge for an independent auditor to give an assurance on non-financial information, right? And sometimes preparation of an integrated report, collecting this data would cost time and investment, so money also. And sometimes they would require outside skills to make sense of the data for the non-financial reporting, right? And sometimes they may have to employ a data analytic specialist or a data scientist to get this information, get reliable information for reporting, for integrated reporting. The last one, I'm not very sure how it would cause disclosure of proprietary information and revelation of competitive information. I'm not very sure of how it would cause that. But if you want to do extra reading, there's a reference there. So 49, it says IMA 2016 Statement on Management Accounting, Integrated Reporting. They're given the page also. Probably there, or there might be a bigger explanation. Okay, otherwise, these are the main things. Basically, the challenge is because it's non-mandatory, people would hesitate to invest time and money, and the standards are not so well formed as in financial reporting, and auditors would find difficult to audit these results. Okay, so that is the main challenges. Sustainability Accounting Board. Now, there's very close relationship between sustainability and integrated reporting, right? So this board formed in the dates are given 2018, and it is a standard forming non-government, non-profit organization, right? So it has comprised standards for 77 industries, right? And basically, the last paragraph, right, is very useful, because Sustainability Accounting Standards Board Foundation is an independent, non-profit, standard-setting organization that develops and maintains reporting standards that enable business to manage and communicate financially material sustainability information to their investors. Okay, so how it can be sustainable, when that is known to the investor, you have won the hearts of some long-term investors, right? So that is that. And not only that, it would reflect well on the employees and other stakeholders as well. Everybody wants something steady. So basically, sustainability is ensuring that long-term survival of the company. So it's all in its infancy still. It's not very well formed, but this is the buzzword these days. Sustainability is the buzzword, and it's going to be given more and more importance, especially in the wake of some companies sacking employees, firing them. Okay, nobody wants to be in a position where the future is so uncertain. So they would want a steady, sustainable job. So they would like to see more reports on sustainability. So with that, we finished section A actually, but we have to do some multiple choice questions on integrated reporting. So that would be in the next session. Hello everyone, welcome to the session on integrated reporting. And in this class, we would do multiple choice questions. So let us go to the question bank. Yeah, so in this question, they are testing you whether you know what are stakeholders. So stakeholders of a local family business, it's a gutter installation company, include all of the following except. So what are stakeholders? Stakeholders are somebody which have an interest in the company. So they would be affected by the company's decisions, and their decisions also would affect the company if they are plenty. So customers, yes, there is a relationship between the company and the customers, suppliers also, employees also. The residents of a neighboring state would not be a stakeholder because they wouldn't be affected directly by the company. And the company also wouldn't be affected by the residents of the neighboring state. So D is the right answer since it's an except question. Let us go to the next one. So here is testing you the different kinds of capital. Again, as a revision, you should remember my memory aid. Finish manufacturing. To remember the 6 kinds of capital. So this is financial capital. This is intellectual capital. And this is natural capital, the nature. This is social and relationships, and this is human capital. 4 of them have been mentioned there: human, intellectual, natural, and manufactured. I put manufacturing, it's actually manufactured capital. Okay, so here they have accumulated data. The data will be used to develop more advanced autonomous features that the company plans to implement in the near future. So basically, this is something to do with intelligence, is it not? Something to do with knowledge. They're collecting data to further develop something. So it's connected to knowledge. So it is intellectual capital. So in integrating reporting, the system used to accumulate and analyze the driving data is best categorized as intellectual capital. So let us go to the next one. Corporate responsibility focuses on. Actually, these are very, very easy questions. It doesn't, it's not challenging at all. So I wonder how the exam questions would be. The previous one was slightly challenging, but not that much. Okay, so corporate social responsibility is what actually? It is actually the impact the organization has on the society. The social responsibility itself is self-explanatory. Okay, so yeah, meeting the needs of the present without compromising the ability of future generations to meet their needs. All these are far away from what is corporate social responsibility. So B is the right answer. Questions here are quite easy. So integrated reporting is defined in the international framework, international integrated reporting framework as a process that results in a periodic integrated report by an organization about value creation over time. So this is the right answer. That's what it does. A periodic integrated report listing out those 6 capitals and about value creation over time. So one thing I should tell you about time is for the non-financial reporting, for the non-financial capitals, the reporting period might be different from the financial capital because it might need a larger time frame in order to report, in order to catch all the cycles of those capitals. So it might be a different time frame compared to others. So yes, about the others, reporting on social capital, it is only one of the part of capitals, okay? And reporting managing decisions, respect of corporate citizenship, these are all not integrated reporting. And reporting on organization use of externalities, I would suggest that you do a research on what is externalities. Externalities are economic events, whether positive or negative. Okay, so it's integrated reporting is not the study of externalities. So A is the right answer. Let us go to the next question. Value creation in the context of integrated reporting is what? It's not only about wealth. It's not only about wealth. It's other things other than wealth. That is only sustainability. A process that optimizes financial performance. Yes, indirectly, but it's not only about financial performance. A process caused by the organization's business activities and outputs that results in increases or decreases or transformation of its capitals. This is value creation in the context of internal reporting. The six capitals is what they're talking about here. A process that optimizes financial performance, it is only about financial capital they're talking about in D, right? So it's capitals, okay, which increases in decrease or increase, and transformations that is best reported as value creation in the context of integrated reporting. Let's go to the next one. Yes, so this one, key companies manufacture of keyboards incorporates financial, non-financial information in it into its analysis, reporting, and decision making. Key companies practicing what? Including non-financial is a holistic thinking, a cohesive approach. It is nothing but integrated thinking. That's what it is practicing. And including non-financial information with financial information, studying their relationship and studying how it affects each other and reporting it would also lead to best decisions, best sustainable decisions. So those are the advantages of integrated reporting. There are some more questions in the Hawk question bank. I would suggest that you do them. I've given you an idea what to do, explain the concept, explain the benefits and the challenges. So that's all you need to be knowing about integrated reporting. May or may not be tested, but since it's a new concept, we really don't know. They can even include it in an essay. So be prepared for this. And with this, we finished section A of part 1. In the next video, we would discuss section B, part 1 in great detail. Hello, everyone. Welcome to the lesson on accounts receivable. So in the last class, we finished about the financial statements. We studied all the financial statements, did all multiple choice questions on them. And now we are going to study each and every element of the balance sheet. And accounts receivable is the first thing that we would study about. So basically, I will share you the text and show you what is it that we have to be familiar with. Okay, so this is about accounts receivable. The main part, because this is pertaining only to credit sales, because otherwise there will not be accounts receivable. So what are the main issues that we would be dealing with here? Valuing the accounts receivable, that is taking into account sales discounts, trade discounts, cash discounts, and putting the correct receivable amount on the balance sheet. And then this is the main challenge: allowance for credit losses. So how do we record allowance for credit losses? There are two types. We'll come to that later. And finally, factoring of receivables with or without recourse. This is nothing but selling off the receivables to a third party and actually make it their responsibility to collect the receivables. So we'll deal with that later. Now, the first thing we are going to study here is valuing of accounts receivable. So for that, let me just go to the whiteboard and explain some concepts. First of all, accounts receivable would be sometimes the credit sales would be given a trade discount. Trade discount are for bulk amount of purchases. There is no challenge in accounting for that. We would just account it for the amount net of the trade discount. For example, let us say the sales value, the list price is, let us say, $100. And as a trade discount, we are going to give them $5 discount because they are purchasing in bulk. So 95. So the entry would be debit AR 95 and credit sales 95. That's it. No complication there. Okay. Then there is a cash discount. Now, cash discount is given for prompt payment to encourage customers to pay within the due date, maybe 10 days within the invoice date, right? So there are two methods of accounting for that: the gross method and the net method. In the gross method, what happens is we account the accounts receivable fully. Let us say 100 is the full amount of the invoice and we credit sales. At the time of payment, at the time the invoice is paid, and suppose the invoice is paid within the discount period and they are eligible for a 2% cash discount, the entry would be like this. The customer would pay only 98 because I'm assuming here a 2% cash discount. A 2% cash discount. Okay, so it would be debit cash 98, debit discount, cash discount 2, debit cash discount 2, and credit the customer fully, credit AR 100. Right? So in the income statement, this cash discount would be a contra revenue. Contra revenue means it would be shown as it's a debit item. So it will be shown under revenue. Revenue is a credit item, but it will be shown with a minus sign like this. And the net revenue would be recorded at 98. Okay. And sometimes they would create a provision for this, not account it when it is taken. So they would estimate some amount of cash discount. So if they are creating an allowance, this would be the set of entries. First, they would record the sales fully. Okay, so if they record the sales as 100, then they would estimate the cash discount which would be taken. So they would debit cash discount to, let us say, and credit allowance for cash discount. And this would be a contra asset. So now in the balance sheet, you would record AR as 100 and this allowance for cash discount as 2. And the net receivables would be 98. And similarly, in the income statement, you would record sales as 100. And then this cash discount expense would be a contra revenue item. And the net sales would be 98. Right? And once the cash discount is taken, the entry would be debit cash, customer is going to pay only 98, and debit allowance. The allowance is a credit item. When you debit, it would vanish. Okay, so debit allowance for cash discount 2. I'm just putting a short form here, debit allowance for cash discount 2 and credit customer fully. So with this entry, this entire thing would become 0. AR would get a credit, it would become 0. Debiting allowance would make this 0 and the entire thing would be 0. This is to account for the cash discount on the gross method. You can also account it by the net method. The net method of accounting for cash discounts is a little cumbersome because they would record it even though the invoice value, let us say it is $100, right? So they would record it net of discounts. So debit AR 98 and credit sales 98. So this is the net method, right? So when the customer pays, he would pay only 98. So it's debit cash 98 and credit sales 98. If he pays the amount, the invoice within the stipulated period for him to be eligible for a cash discount. But in case he does not avail the discount, what we have to do is we have to debit AR for that extra 2 amount and credit probably cash discounts waived, right? Which would add to the revenue. Okay, and then the customer pays, so it would be debit cash 100, which receivables also has 100, and credit AR 100. So this is how it would happen. But to actually select those customers who have not availed the discount and making this entry is a little cumbersome and very, very labor intensive, right? So that's the reason the net method may not be very popular with companies. Most of them, now my company, for example, we get cash discounts from HP. So actually, we are not giving cash discounts, but we are receiving cash discounts, and it's mostly recorded in the gross method. Okay, so that's about it. That is how we would value the receivables and place the correct amount on the balance sheet and take the correct amount as revenue, right? After taking into consideration sales discounts, trade discounts, cash discounts, etc. There's also for returns, sales returns. Now, for example, there's a sales of 1,000, or okay, let us make it 100 itself. And we estimate returns. Now, in order to record sales returns in a correct manner, if the particular sale is eligible for a return, for example, if there is some customer dissatisfaction, the customer is allowed to return the goods within a period of time, right? So in that case, it doesn't mean that we should not record the sale. We can go ahead and record the sales, debiting AR. I'm assuming all credit sales here, and credit sales 100. But we should make an estimate for the returns. So if we have an estimate for the returns, like let us say 5 would be the returns, assuming that $5 would be the returns, then what we do, we would debit sales returns 5 and credit allowance for sales returns 5. Now this is also a contra asset. So in the balance sheet, you would get AR of 100 and allowance for returns. Let us say 5, and we would record 95. And in the income statement, it would be a contra revenue item. You will record the sales as 100, it's a credit item, and sales returns is a debit item, will be shown below the sales with a minus sign. Okay, so that way, and you would record 95. Right? So this is the way it would be accounted for. And in case the customer does return it, what would be the entry? Suppose he returns 5, then it would be debit allowance for sales returns 5. The debit and credit will cancel out, and credit customer for 5. So he doesn't have to pay 100, he will pay only 95 because this AR amount will get reduced. So you will have, after this, the AR being 95 and allowance is now 0. So you would recognize 95, and you have already recognized 95 in the income statement. So this is how we would record for sales returns. So now this is about valuing of the receivables. And the next session, let us speak about calculating the credit loss expenses, because that is the main part of this lesson. Hello, everyone. Welcome to the lessons on accounts receivable. And we already discussed about valuation of accounts receivable. Now we are going to talk about credit loss expenses and credit loss allowances. So this is again valuing the receivable to the amount that could be collected. So let me explain it to you on the whiteboard. So basically, when there is a credit sale, now, by the way, it's quite understood that credit loss expenses would be calculated only for credit sales because cash sales is already received. So it has to be calculated for credit sales. So let us say there's a big amount of sale. debit AR 100 or 1 million probably. Okay. And credit sales 1 million. Okay. Unfortunately, and it's inevitable that some of these sales will not be collected. So what do we do? Now, for example, if 10,000 of the sales is not going to be collected, why don't we just do this? Debit credit loss expense 10,000 and credit AR 10,000. This is when we come to know that this particular customer is bankrupt and he's not going to pay. So debiting credit loss expenses 10,000 and crediting the customer 10,000 looks like a very good way to account this, because there's no estimates involved. This is actual facts. Unfortunately, this is not GAAP. It's not accepted accounting principle. We have to follow the accrual method. The reason being that the sales might have happened, this 1 million sales might have happened in one period, and the write-off, you would come to know that a part of this 1 million is not going to pay probably in the next period or the period after that. So you'll be recording a credit loss expense in the next period. So what's the problem here? The problem here is a mismatch between revenues and expenses. The revenues and the related expenses should take place in the same period so that the profit is good quality and accurate. Now, if the revenue takes place in one period and the loss in some different period, there's a mismatch and wrong decisions might be taken regarding the income in the period where the full sales is recorded. Maybe the shareholders and the stakeholders would think that there's a very good income and they might even declare dividend, and later on to find out that a part of them is not going to be paid. So this would be a problem. So what do? We would actually record the sales and estimate the amount of bad debts or credit loss that we are going to expect in the same period. For example, sales would be this way, 1 million, and credit loss expense would be in the same period like this, and we would record, let me put it as 100,000 as credit loss, 10%, okay? So 900,000 is what we would record. I'm ignoring cost of goods sold, etc., just showing the expense, credit loss expense. Now, what is the entry for this? The entry for this would be debit credit loss expense and credit allowance for credit losses, 100,000. Right? So this is how we would record it. It's also called current estimate for credit loss, CECL. That's what is mentioned in the text. Okay. So this is how the income statement would look under this accrual method. Actually, we are accruing the loss before it happens by using estimates and judgments. It may not be very accurate, but it is better than not providing anything, because it's inevitable that some will not pay. So we have to be conservative. If they pay, well and good, because this is just an estimate, right? Now, how would the balance sheet look? The balance sheet would be looking as following. AR 100,000, assuming the entire thing is a credit sale, and the allowance for credit losses will be a contra asset. I'm sorry, this is 1 million. I'm sorry, this is 1 million. So I'll just write it clearly, otherwise you will get confused. Yeah, 1 million. And allowance for credit losses would be a contra asset, and we would show 900,000 in the balance sheet. Right? So this is how it is. And this is what I would call the sales method of providing the allowance. Here we have estimated the credit loss to be, again, I would write it properly. Here we're estimating the credit loss to be 10% of the credit sales amount. Okay, so this one is purely an estimate subject to judgments and assumptions. Okay, so this is an estimate. Now, if this particular customer does not pay, we had estimated that he may not pay. We had foreseen that. And if he actually does not pay and you want to write off that 100,000, we would actually debit allowance for credit loss 100,000 and credit the customer who is not paying 100,000. So if you notice, there is no effect on the income statement when they write it off. This is the balance sheet item, and AR is also a balance sheet item, permanent accounts. So nothing goes and hits the income statement when they write it off, maybe after several years, because they had already reduced the income statement when the sales took place with this entry, debiting credit loss expense and crediting allowance for credit loss. So when the write-off actually takes place, there is no effect. So this is a sales method of providing for allowance for bad and doubtful debts, or for credit losses, as it's now called. There is now one more thing I should mention here is the sales method is an income statement method. It is the focus here is to concentrate and get the income figure correctly and as accurately as possible. It's an income statement approach. However, there is the balance sheet approach. In the balance sheet approach, let us take the sales, the credit sales again to be 1 million. Right? And then they would actually analyze, they would get at the year end. Now let us say this is the income statement. In the year end, they would get an aging report about the age of those invoices, right? So which made up this $1 million. So maybe there is some current invoice now, just now, maybe a good amount of 800,000. Okay, and then 30 days old invoices, maybe 50,000. And then, or actually, okay, 50,000. And then maybe 60 days invoices, 60 days falling in the 60-day-old category, maybe another 50,000. And maybe 120 days, greater than 120 days, maybe 100,000. So when they get an aging report like this, now we all know that the later the customer takes to pay,
the lesser the probability that we would get the money, the company would realize the money, because the customer is paying either due to financial difficulties, or he doesn't have the proper goods, or he may not have the proper documents to pay the invoice. So maybe ultimately he may not pay because he doesn't have the money. So as a conservative basis, in order to get the balance sheet valuation of the receivables correctly, they would make an estimate of who are the people, what percentage of these age categories would not pay. Here, let us say 0, because it's all current invoices. Here, it's purely a company policy. It's nothing to do with US GAAP. Okay, US GAAP does not give guidelines on how to calculate or what percentage to calculate the allowance. Maybe we'll say that 25% of this would not pay. So 50,000 into 25%, that is 12,500. And then let us say here 50% we are estimating will not pay. That is now 25,000. And here let us say that 100% we are estimating that they would not pay. So the total provision would be 100 plus 25 plus 12.5, 137,500. So the entry would be debit, current estimate for credit losses, credit loss expense, 100 and, oops, one extra 0 there, 137,500, and credit allowance for credit loss, 137,500. Okay, is that clear? And then in the balance sheet, okay, we'll have a credit loss expense here, which is nothing to do as a percentage of sales. It is the percentage of receivables which will not pay. So we would record this in the P&L. This is going to go to the income statement, and this is going to go to the balance sheet. So I'll just show you here, 137,500. So you would record the net income to be 1 million minus 137.5. It will be 862,500. Similarly, in the balance sheet, let us say, of course, this balance would not be 1 million even at the end of the year. Some of them would have paid, but I'm assuming, actually I'm assuming wrong, it's not correct, because this at the end of the aging, you're not going to have 1 million pending, is it not? Right? So it would be different. Now just assume that if this is the case, the balance sheet would look like 1 million. This won't be the case during year end. That's what I'm trying to tell you. So let us talk about, if it is the beginning, you would have AR of 100,000 and the allowance for credit losses 137,500, and you would have net receivables 862,500. So please note one thing. The income statement figure and the balance sheet AR would not be the same. It's not practical. But for this, just to show the presentation of the allowance and credit loss expenses, I've used these figures, but it is not realistic. It's not accurate, because the sales has taken place throughout the year and the AR is at the end of the year. It cannot be the same. It cannot be that all the credit sales have not paid. This would be, AR would be a much lesser figure, and based on that, we would calculate the provisions or the allowances and then provide the allowance. Okay, so this is not very accurate figures, just for presentation purpose, just to show you where the allowance would come, it would be a contra asset, and where the credit loss expense would come, it is not a contra revenue, it will be shown as a expense. Okay, so this is the picture about aging of receivables, or the receivable method and the revenue or the sales method of calculating allowances. Okay, now the remaining concepts, of course, it's not so easy. The questions would be a little bit tricky. The remaining concepts we would learn on the job, that is while we are doing questions, because that is more understandable than if I explain all the theory at one time. Okay, so let us go on to the multiple choice questions on AR and calculating allowances in the next session. Hello everyone, welcome to one more lesson on AR, accounts receivable. So in this lesson, I'm going to show you how to calculate the allowance under the percentage of sales method and the percentage of receivables method. Hawk textbook has a very good example. I'm going to go to that example and explain the concept. So now this is the question. So if you read the question carefully, it's talking about a wholesaler who has the following information. For use in determining its credit loss expense for the year. Beginning balance of AR is given, of the allowance account is also given, and the net amount, the gross, the allowance, the net, and credit sales and collection is also given. He also says that $1,000 were written off as credit losses. So I'm going to show you the entry here. With the help of this example, I'm going to show you the entry of writing off credit of writing off receivables, which cannot be collected. This brought the allowance account to a debit balance of 250, sorry, by using an aging analysis along with relevant considerations about who will pay and who will not pay. The retailer has determined that 6% of the outstanding receivables are expected to be uncollected. The required ending balance in the allowance for credit loss account and the amount of credit loss expense to be charged for the period is calculated as follows. So he goes about calculating it. So I would show it to you with the help of T accounts. In fact, Hawk has also shown it with T accounts. So what I would do is just explain the concept. Now you should remember that 6% of its outstanding receivables are expected to be credit losses. So for that, we have to find out the outstanding receivable. We have to open up a AR account. I'll open up a T for AR. Okay, and open up a T for AR. Post the beginning balance of 10,000. It will be a debit balance. So balance brought forward 10,000. And then credit sales for the period. It would be 2 sales, 60,000. Debit AR, credit sales. Collection is 55,000. So it would be cash, 55,000. Debiting cash and crediting accounts receivable. And then don't forget the write-off. So there's a write-off as well. Now, a write-off would come in the allowance account. So let us open the allowance account as well. Allowance for credit losses. Okay, I'm just going to use some shortened forms here, not going to write the whole thing. Allowance for credit losses. It has a 750 beginning balance. It's always a credit because the expense is a debit and the credit goes to the allowance for credit losses. This account should never have a debit balance. When you're closing the accounts and reporting the results, the allowance account should never have a debit balance. You have to remember that. Okay, so let us go ahead. And then allowance for credit losses, 750. And they wrote off during the period receivables totaling $1,000 were written off as credit balance. So that would be 2 AR or accounts receivable 1,000. That means allowance account is getting a debit and AR is getting a credit because we are reducing AR. Now let me explain this further. Whenever there's a write-off, it's going to be debit allowance account. We are going to use the allowance account, allowance for credit losses, and credit AR. Because we are writing it off, we are removing it completely. So we have to credit it. So that's what I have done here. Right? That's what I have done here. And that has left the allowance account to have a 250 debit balance. So that's what has happened here. In the allowance account, if you look, they had a credit balance of 750 coming from the previous period. They wrote off more than the allowance, 1,000. So it has a debit balance. When the debit side is more than the credit side, it's said to have a debit balance. That debit balance is 250. Now, you have to provide 6% of outstanding receivables. For that, let us find out what is the outstanding receivables. We'll balance the account. 70,000, 70,000 minus 56,000. So 70 minus 56. The balance carried down, is 14,000. Now the company policy, after considering certain conditions, certain risk factors, or whatever method they use, they have decided that they would provide 6% as expected credit losses, 6% on the outstanding receivables. So 14,000 is the outstanding receivables, not yet paid. So 14 into 6%, 14,000 into 6% is 840. Now, guys, when we are doing the percentage of receivable method, we should see that the account, the allowance account should have this required amount as balance. That's it. Okay. So the balance which we would carry down to the next period, the balance that would be carried down. 1 minute. Let me write it clearly. So first of all, the technique for this is you put the balance that has to be carried down to the next period. Okay, so that is 840. And we close this account, 1840, 1840. And what is the amount of credit loss expense that has to be passed in order to have 840 as a credit balance, right? So that would be 1840 minus 750, which is equal to 1090. What's the entry for this? The entry for this would be debit credit loss expense 1090 and credit allowance for credit losses 1090. My figures are not clear, but I'm telling them aloud so you can hear it clearly. Okay. So that's what they have asked us to find out. They asked us to find out the required ending balance in the allowance account, which is nothing but 840, and the amount to be charged to the credit loss expense for the period, which we found out 1090. Now, how will this be shown in the balance sheet? The balance sheet presentation would be as follows. The gross AR would be 14,000. The outstanding balance here, that would be shown in the balance sheet ultimately. The allowance for credit losses would be this balance, which is carried down to the next period. So this period, it would have a closing balance of 840. And the net receivables would be 14,000 minus 840, which is equal to 13,160. This is how the balance sheet presentation would be. And this is how we would calculate allowance based on percentage of receivables method. So always keep the required provision to be the balance in the account. And then pass an adjusting entry so that we get this required balance. So in other words, this is a plug-in. It's a plug-in entry, or what we call in India the balancing figure. Okay, now let us just check whether our answers are correct, whatever we got. So if I go down, Hawk has worked out the allowance needs to have a credit balance of 840, which we got. And what's the charge? The charge for the period is 1090, which also we got. And he has also drawn the T, which is very similar to us. What I have drawn, of course, it's not clearly visible, but yeah. Right, so that's about it. Okay, and then suppose the same question, the same data, they had asked us to find out, calculate the allowance and the closing balance, ending balance in the allowance account, if it was a percentage of sales method and the percentage of estimated uncollectibles is 3% of credit sales. How would we do it? We would do it as following. Suppose the estimated uncollectibles is 3% of the credit sales. Everything else being the same, what would be the... Now we need to only draw the allowance account because AR account is not required here in order to find the ending balance in the allowance for credit losses. Allowance for credit losses and the charge as credit expense. Okay, so the same thing goes. It had a balance of 750. They wrote off 1,000. So credit to AR, debit to debit to allowance, credit to AR. This is for the write-off. This leaves the account with a 250 debit balance like they have told here. Now what you do is just calculate 3% on 60,000. So 60,000 into 3% is 1,800. So the credit loss expense should be 1,800. So I'll say credit loss expense. I'll write it clearly. Sometimes the handwriting was really bad because it's not easy to write on the digital board. So credit loss expense. Again, I made the mistake. Credit loss expense is 1,800. And that's it. Nothing else to be done. Right? We get the balance. What is the balance here? It is 1,800 plus 750, 2550, 2550. So the balance of this account has an excess of credit balance of 1550. So that is the balance to be carried out. So in this, how would we show? Now this is the plugin here. Okay. So now the balance sheet presentation would be the gross AR is 14,000, which we calculated under the percentage of receivables method. If you remember, 14,000 was the outstanding. And the allowance is a contra asset with a balance of 1550 and 12,450 is the net receivables. I call this net AR and this gross AR. So with this, you understood the different methods of calculating allowance. The percentage of sales method is just blindly calculating the percentage of uncollectibles estimated on the credit sales. And we really don't bother about maintaining a certain amount of credit balance in the allowance account. We just pass this. It's an income statement approach. So basically, we are just passing it to match the revenues and not to value the receivables correctly. So that is not the criteria here. Whereas in the percentage of receivables method, the aim and focus is to value the receivables for balance sheet purposes correctly. So that's why there are various methods of doing it, right? But one of it is the aging method, aging of receivables method. So with the help of that, they actually make an estimate of how much is not collected based on the fact that the later or older the invoice, the less likely it will be collected. And that way they would pass the provision so as to keep in the balance sheet the exact amount or almost the same amount that would be collected. So that is the focus of these two methods of calculating allowance for credit losses. Now, since I have shown you properly with an example how both the methods are calculated, I think now you are ready for multiple choice questions on this topic, which I would do in the next session. Hello, everyone. Welcome to the lesson on MCQs on accounts receivable. So let us start with the first question. I will share the screen. It says, on the statement of financial position, accounts receivable is valued at A, current market value, B, estimated net realizable value, C, original cost when the asset was acquired, D, amount payable when due. First of all, it's an accounts receivable and it's not payable. So D is fully ruled out. And C also, it's not the original cost when the asset was acquired because there could be changes. There could be bad debts. There could be credit losses. So B is the correct answer because what is going to be received, what is estimated to be received, only that is put on the balance sheet. Statement of financial position here means balance sheet. So B is the right answer. Let us go to the next question. This looks a huge one. Let me just reduce it a bit in size, but still it goes off. Yeah. So take some time and read the question carefully. And later on, pause it, try to answer it yourself, and later on check my explanation. So here basically, to summarize the whole thing, he uses the current expected credit loss model. That means they are in the habit of making provisions or accruing credit losses before they actually happen to value its accounts receivable and is making annual adjustments at the fiscal year end. Now the year end is November 30. Credit losses are estimated based on all relevant information, including past experiences, current conditions, reasonable forecast, qualitative and quantitative factors. Total sales were this much, all of which were credit transactions. Now, the company has determined that one customer called Norris Corporation is going bad. So the balance of 10,000 is a loss and will write off this account before the year-end adjustments are made. So list are the below Madison's account balances at 30th of November prior to adjustments and the write-off. So what is this adjustments they're talking about? Adjustments are to have the required balance, to have the required allowance for credit losses in the allowance for credit losses account. Okay, so that is the adjustment, but they have not yet written off, and before they written off the account, this is how the account looks. The accounts look. Sales is there, 1.8 million. 750,000 is accounts receivable. And if you notice here, the total, now this is 750, this is before the write-off. And the ones which they're showing now in the aging is after the write-off. So it's only 740,000. Okay, so that's how it has to be understood. Now, there's the balance of the credit losses, allowance for credit losses account, the sales returns. The sales returns, etc., is not relevant to this question because in this question, they are going to provide a current expected credit loss expense based on the aging of accounts receivable. So he says here, Madison values its accounts receivable using an accounts receivable aging schedule. The chart below represents the aging of the accounts receivable subsidiary ledger at November 30, and now it's not including the account to be written off. So they have written off that 10,000. That's why from 750, it has become 740. Okay. So now, going further down, this is the percentage they are going to provide for credit losses. So the percentage of credit losses is given here. Okay. So 1% of this is going to be 3,900. 390,000 into 1%, 3,900. I would suggest you multiply it into 1% and put it into memory plus. Then later on, recall the memory. It's much easier that way. So, and you can also truncate the zeros if you want to. And then 115,000 into 5%, which is 5,750. And yeah, and 210,000 into 15%, which is 31,500. If you notice, as it gets old, the percentage of estimated credit loss is increasing. And then if it is more than 120 days, it's going to be 25,000 into 40%, which is 10,000. Right. And if you add up all this, if you add up 3,900 plus 5,750 plus 31,500 plus 10,000, we get 51,150. 51,150. So this is the required provision. This is the required provision. Now, the question is to find out the final entry to the related accounts. Right? So we should check which would be the final entry. Let us first, you see, mainly the final adjusting entry would be for the credit loss expense. So let us put down the allowance for credit losses account. I'm putting some short cuts there, short forms there. Allowance for credit losses. Okay, so it had an opening balance of 16,500. So that is a credit balance always. Need not be, sometimes during the year it can have a debit balance, but then once you close the accounts, it should have a credit balance. And here the brackets represents a credit balance. Okay, so that's what it means. And here, all right, and then later on they write off that Norris account. Okay, so I'll just put AR there, which represents Norris Corporation account, which is 10,000. Right? When you are making provisions or you want to find out the adjusting entry, first put down the balance required, that is 51,550. So this is the balance, 51,150, I'm sorry. So this is the balance the account should have. And then close the account and see how much should be the adjusting entry. So this is 61,150, 61,150. So the adjusting entry would be, yeah, 61,150 minus 16,500. So current estimate of credit loss expense would be the adjusting entry or the plug-in entry of 44,650. It's the plug-in entry. Right? So that is how it should be understood. And now, what is the entry for this? If you notice, the entry should be a credit to credit law allowance for credit losses, because it's appearing in the credit side. Allowance for credit loss. And the debit should be in the income statement, current estimate for credit loss expense. So that would be the debit entry. So 44 650 and 44, 650. So this should be the correct entry. So that's what they're asking you. So let us look at the choices there, what they're given us. Choices, the first one is, saying debit the allowance for credit loss account and credit the credit loss expense account. This is a write back entry. This is a write back entry which is done when there is excess allowance and they are going to debit allowance for credit losses, thereby reducing that excess balance and reducing the credit loss expense by crediting it. This is not what is done here. Here we are increasing the credit loss expense. So A is not the answer. How about B? Debit the allowance for credit loss account. We are not debiting it. And credit sales. Nope, certainly not. Credit accounts receivable, we did not do that. And debit credit loss expense. This is a direct write-off. And anyway, the figures are not correct. Credit the allowance for credit loss. Yes, we have done that. And debit credit loss expense 44,650. So D is the final entry to the related accounts. Now, guys, before you even ventured to solve this question, if it's in the exam, I think it is very easily solvable because the first one is a write back entry. Write backs very rarely happens. Actually, you wouldn't get questions on writing back. Practically, yes, sometimes we do write back excess balances. But in our company, with my experience, we rarely do that also because there's hardly any excess balance in the credit loss account, right? It would always require more allowances. So this is definitely not an, a conventional entry which people do, not the normal entry. And the second one, if you see, debit the allowance for credit loss and credit sales. If you do this, I think you will lose your job. Okay, so this is an entry which is not at all logical. The credit for sales would come from invoicing and not from manual entries like debiting allowance for credit losses. It's a totally invalid entry. Now, credit accounts receivable and debit credit loss expense is a direct write-off, which is not GAAP. So we wouldn't do this. So the only valid entry, even without calculating this amount, forget the amount, even by looking at the choices, the only logical valid entry is D. So you can home in to the correct answer without doing all what I just now showed you, like opening the T account, etc. Right? So in the exam, by just looking at the choices, you would save a lot of time by just logically thinking and marking D as the answer. I have actually worked out the entire thing for you to understand, for understanding purpose, because you are studying here. So to understand it, how it all appears in the allowance for credit losses, etc. Okay, so that's what we should be understanding. That's how we should be understanding this question. So some people, some of the students do have a confusion sometimes whether this allowance for credit losses is a debit balance or a credit balance. In my experience, I have come across students asking me that. They would argue that sales is always a credit and is shown without brackets, whereas allowance for credit losses is showing within the bracket. So is it a credit item? The answer is no. Generally, generally allowance for credit losses would have a credit balance. If it has a debit balance, they would mention it. They would mention it. Okay, so that is the reason, right? We are taking it for granted that the balance which is shown here is a credit balance. So now let's go on to the next question. Okay, so just read the question carefully. Right. So what they say is this company, Brighton, was using a percentage of sales method to calculate credit loss expense. It was using 1.5%, 1.5% of credit sales. Now it uses current expected credit loss model to estimate credit loss expense using the aging schedule and other relevant information to estimate how much is collectible and how much is not. So now it's estimated the probabilities of collection for each group from past experience and all other information which help them to forecast properly the collectability on accounts receivable. They have given a lot of relevant and irrelevant information here. So what I would suggest is read the last line first and then read the whole question. So using the current expected credit loss model and the information in the aging schedule, the balance in the allowance for credit loss accounts after the adjusting entry is made will be how much? So that's what they are asking you. Now here it's very simple. This question is very simple because the balance in the credit loss allowance for credit loss account should be the amount which is not going to be collected, which is estimated, which is an estimate of uncollectible amounts. So if 98%, this is 98%, 0.98, is the probability of collection, that means 2% is uncollectible. And similarly, if 92% is collectible, 8% cannot be, is estimated not to be collected, and 25% here, and similarly 40% here. So now you would calculate based on these percentages, the uncollectible amounts. So do not calculate what is collectible, what is not going to be collectible. For example, it's going to be 2% of 640,000, right? You can truncate the zeros, do not put all the zeros, and use memory keys. For example, you should be doing this like this, 640 into 2%, and put it in memory. Similarly, 180, put it into 8% and put it in memory. Press memory plus in your calculator. And so on for the others. 95 into 25% memory plus, and 40,000 into 40% memory plus. If you recall the memory recall, MRC, memory recall or cancel. So if you do that, you are going to get 66,950. And that should be balanced in the allowance account. They're asking you the balance in the allowance for credit loss accounts. So A, the uncollectible amounts, the estimated uncollectible amounts should be the balance in the credit loss account. They have not asked you the adjusting entry to make the balance 66,950. That might be another question altogether. Here you have to just find out the balance. Now guys, now I'll ask you a question. How much is the gross receivable how much is the allowance for credit losses, and how much is the net receivable when they close the accounts on 30th November 2004. Now, I would suggest that you pause your recording, pause the recording, and try to fill up these blanks which I've asked you, and then put it on and see whether your answer agrees with mine. So, this is going to be the gross AR before providing any allowances for uncollectibles. Then the allowance for credit losses balance we just now found out. It should be 66,950, and the net AR is just subtracting the uncollectible. So that is 888,050. So this is the net AR. I hope you have understood this, and I hope you also arrived at the same answer. If you have done that, then you are on the right path and your concepts are getting clearer. So now let us go on to the next question, but we will continue this in the next session. We don't want to make the recording too long, so it will be continued in the next session. Hello everyone, welcome to the next session on MCQs, multiple choice questions on AR. So in the previous class, we had done this question. So the question was, the final entry related to the accounts is what? Okay. Now, my question to you, just to test your understanding, is for the same question, what is going to be the gross AR? That is nothing but the balance sheet presentation. Gross AR, the allowance, sorry, allowance for credit losses, and what is the net AR? Because in the balance sheet, it would be presented this way. The allowance would be a contra asset. That means it will be shown in the asset side of the balance sheet with a negative sign. So yes, try to solve it by yourself by pausing the recording and then look at my explanation. So now, the gross AR is going to be 740,000 as per the aging report. That's the total AR. The allowance is going to be not that 44,650. That's the adjusting entry. If you remember, the choices said 44,650. D was the answer for the final entry. But that's not going to be the balance in the allowance account. That adjusting entry is made to bring the balance to what was required, the amounts not estimated not to be collected. Okay, the amounts which are estimated as uncollectible is 51,150. That is the sum of all these estimates. What we had calculated in the previous session on MCQs of AR. So when we calculated this, we got 51,150. The adjusting entry to make the balance 51,150 was 44,650. So the net AR is going to be just deducting this from 740,000. So that's going to be 688,850. This is not asked in the question, but it is for your understanding. They could always ask that as one of the multiple choice questions or even in an essay. So yes, so that one, this one we have already done, the gross AR, the allowance and the net AR, as well as we found out the balance. We have done this in the previous class. Now again, Brighton comes into the picture. Now he's asking, what is the credit loss expense? All the same data. The data is the same. So what is the credit loss expense using the aging schedule? So it's a percentage of receivables, not percentage of sales, right? So how do we do that? Drop the account. Drop the allowance for credit losses account because the adjusting entry for credit loss expense would appear in this account. So what's the opening balance? The opening balance of the previous year, it had a credit balance of 76,500, right? And then a debit balance during the year, it developed a debit balance of 3,400. So what does that mean? It means that for it to develop a debit balance, the debit side is more than the credit side. So now there's not going to be change in this opening balance. So during the year, the debit side became more than the credit side by 3,400. That is, the debit side would be 76,500 plus 3,400. So 76,500 plus 3,400 would give us 79,900. So I would put that there, 79,900. Now it has a debit balance of 3,400. Now, why does it have this big debit of 79,900? Because they wrote off accounts receivable. This account allowance for credit losses would get a debit because of a write-off of accounts receivable. So what's the entry here? Basically, it's a confirmed loss. So debit allowance for credit losses 79,900 and credit accounts receivable 79,900. So that is the entry which is causing the debit balance. So in other words, they had estimated that 76,500 is not going to be collected, but actually 79,900 was deemed to be uncollectible. These are the actual uncollectables, okay, where it's confirmed that they are not going to pay. So that's about that. That's how it got 3,400. Now, how much is going to be the credit loss expense? For that, just put the balance which the account should have, the balance which should be carried down to the next year. We already found it out, if you remember, by taking 2%, 8%, 25%, and 40%. These are the uncollectible estimates. If the probability of collection is 98%, 92%, 75%, and 60%, the opposite should be uncollectible, 2%, 8%, etc. When we calculated these amounts in the previous class, in multiple choice session 1, we got 66,950. So that's not the answer for this question, okay? But that's the balance we need to be maintaining in this account. So that's the balance we carried down. Now the plug-in figure is going to be the credit loss expense. expense. Okay, so now we'll do the math. 66,950. We'll try to balance the accounts. It's going to be 146,850. 146,850. And therefore, the credit loss expense would be 146,850 minus 76,500, which is equal to 73,350. So this is the answer. This is the plug-in figure. And B is the correct answer. Okay. So that is how this should be worked out. But if you analyze a little more, this adjusting entry is actually made up of that 3,400 excess what they had written off compared to what allowance they had, plus the required required estimate of uncollectibles is 66,950. So if you add these two, it's going to be 73,350. So that's the adjusting entry. So the adjusting entry is actually putting the excess write-off as an expense, as well as providing for the current expected credit loss of 66,950. So we are putting both of that as credit loss expense. I hope it's clear. Let's move on to the next question. Again, it's Brighton. And this time, if you read the last sentence, they are asking you how much was written off by Brighton. This is very simple. In fact, it was already done in the previous question. We had already discussed that. How much was the write-off? So the allowance for credit loss account had a balance from the previous period of 76,500 credit given there. And thereafter, during the year, there was a write-off, maybe one amount, maybe several amounts. But for it to have a debit balance, the debit side should be more than the credit side by 3,400. And that happens because of write-offs. So it's going to be 76,500 plus 3,400, so 79,900 should be the write-off. In fact, we did this. We discussed this. So this is the answer, finished. That's all. They've not asked you the balance in the allowance account, nor the adjusted entry. They asked you how much they have written off. Accounts receivable written off. So B is the correct answer. The next question is similar to what we have done. Pause it, read it carefully, and then look at my explanation. So what does it say here basically? Just a minute. Yeah, previously it was estimating credit loss expense as using this percentage of sales method. But it now uses the current expected credit loss model using aging analysis. Very similar to the ones we have done. So the following accounts receivable aging schedule was prepared: under 60 days, 61 to 90 days, 90 and over. So if you notice here again, the percentages increases as and when it gets older. The amounts get older because the probability of collection reduces for old receivables. They've asked you, they've given you here the sales out of which this is credit. All these are not relevant for this question. Okay, so they are asking you the adjusting entry to the allowance for credit losses using the aging model, okay, made on 30th of November of the current year. Now, the adjusting entry is always the credit loss expense. Which is made, credit loss expense, which is made in order to bring this allowance account, allowance for credit losses, in order to bring this balance, the allowance for credit losses balance, to the required amount of estimated uncollectibles. So here they have given you the percentage of estimated credit losses. Multiply it and add them. Use memory keys. Use memory keys. So if you do it fast, 730 into 1% and 40 into 6%, 18 into 9%, and 72 into 25%. If you recall the memory, you should get 29,320. So 29,320. So that should be the balance. To balance carried down 29,320. This account should have a balance. But he also says there is a debit balance in the allowance account. So now this happened during the year. They would have not started off with a debit balance. Please bear that in mind. So this balance, this debit balance happened during the year. And that happens because of a write-off in excess of the existing provision. So we can now, they have not given us how much was the opening balance or the beginning balance in the allowance account. You can imagine anything. So if the balance was, let us say, 30,000. For you to have a debit balance, that means they wrote off 44,000. Only then they would have a 14,000 debit balance. So it can be anything. It can be 20,000 as the beginning balance and 34,000 as the write-off. Basically, they have a debit balance because the write-off is more than the provision that existed. So now that's what it is all about. Now you can balance the account 44,000 plus 29,320 is 73,320. Okay, and now you will get the plugin for credit loss expense, which is the adjusting entry as 43,320. This is the adjusting entry to bring the balance up to 29,320. Sorry for not being clear. Okay, so that is what it is all about. And this adjusting entry as an expense would include that 14,000 of write-off in excess of the provision. That's what it gave, a debit balance, plus the required provision of 29,320 got by multiplying all this and estimating the credit loss. So that would give us B as the answer, not C, because he has asked you the adjusting entry. So now, my question again to you is, in the balance sheet, how would you present all this? So what is the gross AR, the allowance for credit losses, and what is the net AR? pause the recording and try to fill up the blanks yourself. And then look at what I do. So basically the gross AR is this balance amount, the total of that, which is 730 plus 40 plus 18 plus 72. So that gave us 860,000. So that gave us 860,000, which again is a total of all this, 860,000. That's the gross AR. And what is the allowance for credit losses? Take a guess. It is not 43,320. 43,320 was an entry made to bring the balance to the required amount of estimated uncollectibles. So that is 29,320. That's the balance in the allowance for credit loss account. And the net AR is going to be 860,000 minus 29,320, which is equal to 830,000 and 680. This is just for your knowledge. You don't have to do it in the exam. This is just for you to understand the whole concept better. Let us continue in the next session. So that would be MCQs on AR session 3. Hello everyone. Welcome to the third session on MCQs on AR, accounts receivable. So let us continue with the question bank. I'll share the screen. Yeah. So now this question is asking you, as I told you before, just read the last line. What is the amount of accounts receivable written off as credit loss during the year? So all that can be seen in the allowance for credit loss account, the write-off, the entry for the credit loss expense, etc. So let us just look at the allowance for credit losses, that account. So he says the analysis of the company's 150,000 account receivable at the year end resulted in the in a credit ending balance of 5,000 for its allowance account. So we are talking about year end here. So we are talking about the balance he's going to carry down to the next period. So that is 5,000. And a credit loss expense of 2,000. So that would be a debit to credit loss expense and a credit to the allowance for credit loss. So it would be here, credit loss expense. He says that is 2,000. Again, let me just put down this entry. The entry for this would be debit credit loss expense of 2,000 and credit allowance for credit losses. So that is why it is happening. It is coming in the credit side of the allowance for credit loss account. Right. Now he says that during the past year, recoveries on credit losses previously written off were correctly recorded at 500. Now, what's all this about? I have explained you earlier, whenever amount which was previously written off is collected, there is a separate set of entries for that. So, we would reinstate the accounts receivable balance. Now see, the write-off is debit allowance for credit losses, right? For credit losses, which is 500, and credit AR. So this is what they previously wrote off. right? And now it is collected. There's a recovery. So what do? We should reverse this entry and reinstate the accounts receivable balance, because when the customer looks at his statement, he should see that this amount is paid. If we directly credit some revenue account for this, some other income account, it would not show up in the accounts receivable statement. So what we do here is we would debit, in fact, we would reverse this entry. Debit AR 500 and credit allowance, this is credit by the way, credit allowance for credit losses 500. So they would be by AR of 500. So AR is debited, allowance for credit losses is credited, right? And if the beginning balance for credit losses was a credit balance of 4,700, that is the balance here in the beginning, balance brought forward in the beginning was 4,700. What is the amount written off? So we have all the amounts here. We have to plug in the amount written off, right? So we just need to balance the account and we get our answer. So it's 4,700 plus credit loss expense of 2,000 plus 500. So it's 7,200. If my handwriting is not clear, please listen carefully to what I'm saying, because as I write, I'm actually saying what I'm writing. Okay, so if my handwriting is not clear, my speech is clear and you would understand it, right? So to AR, the plug-in figure to make debit and credit equal is 2,200. So what's the entry here? Debit allowance for credit losses and credit AR. We are removing AR. That is what is right. That is what write-off is all about. So C is the right answer. So we got the right answer. My question to you is, as usual, like I always asked you for the other questions as well, in the balance sheet, what will be the gross AR? What will be the allowance? What will be the net AR? Take a little break, pause the recording, and then fill up these blanks and see if your answer is agreeing with what I write here now. So that is 150,000. He has given you the AR balance at year end. And the ending balance of 5,000. So this is the balance for the allowance account. That would be the balance. And the net AR would be 145,000. I hope you understood this question in its entirety. You should be understanding all aspects of it, because in the CMA exam, they would test you as if you are an expert and you are expected to know it. Okay, so you should be quite thorough with all the concepts of AR. So now let us go on to the next question. Not this one. The next question here is to do with pledging and factoring and assignment, which I would be doing after I do accounts receivable accounting. Now, this one is quite a challenging question. It says, how much cash was collected from accounts receivable? Now that could be seen in the accounts receivable account. So drop the accounts receivable account first, right? And then we may have to draw up the allowance account as well. And they have given you some data here. There has been an increase in net accounts receivable. Now, and there's also some information here. In fact, this is all what they say is incomplete set of facts, right? So credit loss expense is 2,000, and then there's additional data. Now, beginning balance of accounts receivable was 5,000, so we put that balance there. It is coming from previous period. It's a debit balance brought forward, and beginning balance of allowance for credit losses is a credit 500. So balance there, credit 500. Accounts receivable written off is 1,000. This is all for the period. So 1,000 written off. So I would say allowance account, debit, AR credit, allowance for credit loss. I'll put like this, 1,000. So if this is a 1,000 here, it should appear here also. AR 1,000. So what are we doing? Debiting allowance 1,000 and crediting AR 1,000. I hope that is clear. Everybody should be familiar with all the accounting entries, right? And now, he says that there's been an increase in net accounts receivable for 30,000. So these are the data they're given. What do they mean by this? So it means that if year 2 is the current year and year 1 is the previous year, the net AR is more by 30,000. So that's what it means. Okay, so how do we find that out? So for that, let us look at the beginning balance for the year. Okay, so the beginning balance for the year was 5,000. That means that would have been the year 1 closing balance. And the credit, the allowance was 500. So it implies that the net AR for year 1 is 4,500. Right? Because receivable beginning balance means it was the previous year's ending balance. So now what has happened is, what has happened is this should be 34,500. Why? Because 34,500 minus 4,500 would give us what they are talking about here, a net increase in net accounts receivable, which is 30,000. Okay, so now what we should do is find out what is the year 2 ending balance of accounts receivable. For that, let us first get the allowance for credit loss account, right? So there, the ending balance for the allowance account would be 2,000 as credit loss expense. He has told you that credit loss expense 2,000, which implies that now this balance is going to be, the balance is credit side more than the debit side by 1,500. It's a plugin. This is the ending balance for the allowance account. So I can put there 1,500. Now, what is going to be the gross AR? The ending balance of AR in year 2. If the net is 34,500 and 1,500 is the ending balance in the allowance account, it implies that the gross AR should be more So 34,500 plus 1,500 would be gross AR. 36,000 would be the gross AR. We can verify it. 36,000 minus 1,500 should be equal to 34,500. So now we got the ending balance. Balance carried down for year 2 is 36,000. Right? He also says credit sales, net credit sales is 1,000, which means sales credit, AR debit, 100,000, sorry. Right? So that's it. We can close the account and get the cash collected. So this side is 105,000. 105,000. The plug-in should be the cash collected. So that's what they asked you in the question. How much cash was collected? So 105,000 minus 36,000 minus 1,000 would give us 68,000. So this is the plug-in figure, the balancing figure, and that is the answer. So as you see in this question, there are a lot of things to be considered, right? But sometimes I wonder whether we can do it in this way. Let us talk about sales, which comes, we are doing it in the statement of cash flow method. Let us say sales is 100,000 and let us forget all the other expenses. Let us assume that only sales is there 100,000. So that would be in the income statement, and 2,000 credit loss expense would also be there in the income statement. So a total of 98,000 would be there in the income statement. And this would be the starting amount, starting figure to determine the cash flows. And you know very well, increase in AR is a deduction because it is increasing income without bringing in cash. So when we want to arrive at the cash balance, we deduct the net increase in accounts receivable. So when we do that, we automatically get 68,000. So, well, I don't know whether this is my method of doing it with just a few steps, doing it the cash flow method, right? So just think about it and see if this is a logical way of doing it, and get back to me during office hours to discuss this further. Because I just wondered now, instead of doing this question in this method, which is the correct method given in the question bank, in the suggested answers, right? I was wondering whether this shortcut makes logical sense. Okay, so if you guys have any doubt on this, or if you feel that what I have done is not very correct, not logical, please get back to me and we can discuss this further. But I get the same answer. But getting the same answer doesn't necessarily mean that I have arrived at it with the correct concept. Okay, so it is open for debate. Right, now, the last question of this lesson, before we move on to factoring, is this. So this company, Johnson, uses the current expected credit loss model to account for expected credit losses from its account receivable. In other words, they're telling that it's accruing its credit loss expense. After recording the estimated credit loss expense for current year, he decided to write off 10,000 for a customer who is bankrupt. He's asking, what effect does this write-off have on the company's net income and current total assets? Okay, now let us imagine some figures. Let us imagine 100,000 AR. And let us say an allowance which was previously recorded. During the current year, it was recorded. So you would have debited the expense account and credited allowance account as 10,000. So you would have 90,000. Assume that these are the only assets the company had. Okay, the current assets, the total current assets. Assume that only AR was the current assets. There was no inventory, there was no cash. We can easily assume that. And then they wrote off this amount. And when they write off, the entry is going to be debit allowance for credit losses, $10,000, and credit AR, accounts receivable, 10,000. If you notice, this is a balance sheet amount, balance sheet account. This is a balance sheet account, and AR is also balance sheet account. So net income should not be affected at all. What about these? What about the current assets? AR is definitely going to be affected. You wrote off, so you wrote off 10,000, so that would become 90,000. And the provision had a credit balance of 10,000. You debited it, so that becomes 0. So those individual accounts do change, but the total current assets would remain the same, 90,000, 90,000. Only thing, the AR balance has changed and the allowance balance has changed, but the total is the same. So the answer is D. Net income will remain the same and the total current assets will remain the same. Net income will remain the same, as I told you, because both the accounts affected by the write-off are balance sheet accounts and nothing would come into the income statement. So the question is asking you, please note here, what effect does the write-off have? He did not ask you what effect does the recording of estimated credit loss expense have. That would definitely, that recording of the credit loss expense would hit the P&L or the income statement. But the write-off does not hit the income statement in any way, right? And as you saw here, there was no change in total current assets. So D is the right answer. And with that, we finished accounting for receivables, right? And in the next class, we would talk about factoring. In the meanwhile, I would suggest that you would go into the question bank and see whether there are some questions on percentage of sales method of calculating allowances. Okay, I have done that in one of the sessions and explained it with an example. So just let us see whether in the question bank there are questions related to the percentage of sales method. Practice it. If you find a problem, if you couldn't solve it, please get back to me during the office hours. Hello, everyone. Welcome to the lesson of factoring. Now, let me first explain the concept to you, and then we would solve multiple choice questions. So what is factoring? Factoring is nothing but a sale of the accounts receivables. So just to demonstrate, let us say a company has an accounts receivable of, let us say, $100. Can be 100,000, can be anything. And it sells it to a factor. Factor is any financial institution, could be a bank, could be any financer who is prepared to buy the receivables. So he buys the receivables and he would have to sometimes advance cash, right? So he would sometimes advance cash. And this sale could be with recourse or without recourse. What do you mean by with recourse and without recourse? Without recourse is if some of these receivables go bad, the factor cannot go back to the seller and claim the money. The credit loss is transferred to the factor. So the factor is taking on more risk than in a transaction with recourse. In with recourse, the factor would buy the receivables on a condition that if something goes bad and some receivables do not pay, the factor would get back to the seller of the receivables and claim the money, since he has already transferred the money. Sometimes the factor transfers the money in advance before it's collected. And sometimes he transfers the money after the receivables are collected, right? So if he transfers the money before the receivables are collected, he would also charge an interest for the amount, for the average time to maturity of the receivables, right? So that is how the deal is. Now, the factor would not give the seller the entire 100. He would make several deductions. One is his factor fee. This factor fee would be greater if it is without recourse, because the factor is taking on more risk of credit loss. So the factor fee might be 5%, let us say, if it is without recourse, and 2% with recourse. Okay, so he would take on, let us say 2% in this case. And also a factor reserve. He would not advance all the money, but he would keep a reserve just in case some of them do not pay. This is in the case of with recourse, okay? And also due to sales returns. Maybe some customers return the goods, in which case they would not pay. So the factor, before advancing all the money, he would keep a reserve for such cases. Let us say 8%. So let us say the factor fee is 2%. The factor reserve is 8% on the original amount, so 8, right? So now he would have to transfer actually 90, but he would also charge interest. Let us say interest is 15% per annum, and it is for, let us say, 60 days. Assuming that the average time to maturity of these receivables is 60 days. That means that the average time the receivables would take to collect all the receivables would be 60 days. So in which case the calculation would be as following: $90 into 15%. So that is how much? So 90 into 15% is 13.5. But this would be for the entire year. So I'm assuming a 360-day period. So divide this by 360 days. So 13.5 divided by 360. You would get it per day, and you calculate it for 60 days. So into 60, I get 2.25. So 2.25 is the interest. 2.25 is the interest, and the factor would advance 90 minus 2.25, which is 87.75. So this is how the transaction would take place, and this reserve would be returned back to the seller if all the receivables are collected. So this is an asset in the books of the seller. So when the company sells the receivables, the entry would be debit cash, just assuming this was the transaction, 87.75, and debit factor fee, 2%. So that is $2. And debit interest charges. This was the interest, that is 2.25. And debit factor reserve, which is an asset, which would come back later on, $8. And then credit accounts receivable for the full amount. So if you notice here, the accounts receivable is fully off the balance sheet. It is removed off the balance sheet. And in case of recourse, the seller would also record a recourse liability, just in case that the seller may have to pay something to the factor, right? So in case of a recourse, there would be another debit called recourse loss. Let us say they're estimating that $5 would go bad, and then they would credit a recourse liability. Recourse liability of $5. Now, some say that this is very similar to the allowance for bad and doubtful debts. I beg to differ, because it is not exactly like an allowance. In a case of allowance is not a liability. It's a sort of a valuation to value the receivables correctly, right? So you don't owe that money to anybody else. The company doesn't have to pay the allowance for bad and doubtful debts or allowance for credit losses to anybody. Whereas this recourse liability would be recorded in the liability side of the balance sheet, and it may have to be paid back to the factor. So in a sense, it's a real liability. So this is only in case of a transaction of factoring with recourse. If it is without recourse, the credit loss would be borne by the factor, right? So these are the entries which would come in a normal factoring with recourse, fine? And main thing, it is called an off-balance sheet transaction because it lightens the balance sheet. So I'll just show you how. So, okay, so just before that, in case $3 do not pay, right? Let us say the recourse liability was, they are estimated at 5, thinking that $5 of a customer would not pay. But in case $3 do not pay, you debit this recourse liability for $3 and credit credit cash $3. Okay, or you can do this way. You would debit recourse liability for the entire $5, credit cash $3 because $3 has to be paid to the factor, and credit the recourse loss which you had recorded. Now you are reversing it slightly. Okay, the recourse loss for $2. So then the recourse loss will reflect the proper debt which went bad, which is the proper credit loss, which is $3. So now what would hit the P&L? What's the cost of this factoring? The cost of the factoring would be these two amounts, which they would never get back. The factor reserve would be refunded if there has not been any sales returns, etc. Okay, so it would be 4.25 plus this $5 or whatever is in the recourse loss account. Okay, so that would be the real loss due to this factoring. So I hope it is all clear to you. In the text, they have given that traditionally most of the factoring is without recourse, right? Because the company doesn't want the factor to come back to them for any bad customers. They want to transfer the entire risk to the factor. But in reality, because I have worked in the industry, banks don't transact without recourse. Okay, so as per my experience, it has always been with recourse, and the charges are horribly high, especially in the country which I worked, which was Kazakhstan. The charges were too high, and in the end, we did not go ahead with the factoring because he was not buying all the receivables. He was buying only the good receivables. So, I mean, the good receivables will anyway pay. We were concerned about the bad receivables or the not so good receivables for which we wanted to transfer the credit risk, the credit loss risk to the factor, for which we were ready to pay a reasonable sum of money for the risk and the work he would do. But the charges were prohibitively high, and so we did not go through with the transaction. So generally, once a sale is done like this, the company has no responsibility whatsoever for the receivables. The company would remove its accounts receivable from the balance sheet and reverse any allowance for credit losses, which was there on the balance sheet. And instead of that, if it is a recourse transaction, they would reinstate a recourse liability onto the balance sheet. And all the customers would pay the factor. Sometimes the factoring deal is with notification to the customer saying that they have to pay to the factor, and the factor would put his seal and bank details on every invoice to the customer. Sometimes it is without notification. The customer doesn't know it has been their dues has been sold to a factor, and they continue to pay the company, and the company then pays the factor. But most of the time, the customers are informed of this deal and they pay directly to the factor. And if there is any delay, on the part of the customers, in case they pay more than the due date, right? So at that particular time, for that time, the factor would charge the customer interest as well. So if the customers fail to pay within the due date, for any extra days they take to pay, the factor would charge them interest. So this is how the deal goes in real life. And factoring is quite common. It's a sort of a financing and an off-balance sheet financing. Now, why is it balance sheet? I will just demonstrate to you. There is something called assignment of receivables. So I'm just going to draw a balance sheet in an account form, P account. This is a balance sheet, right? And let us say there is accounts receivable of 100, right? Equal portion would be there of equity, 100, okay? So this is how it would be. Now, in case of an assignment, this, or pledging as they call it, pledging is more informal. So the company would give this to the lender. he would not exactly sell it to the lender, but is going to keep it as a collateral. He's going to pledge the receivables to the lender. And the lender, in turn, would give him cash. So it's just like any loan transaction. The lender would give cash, probably not the whole amount, because they would keep a safety margin. Maybe they would give 95. And the company would also record a loan of 95. And the company would have to pay this loan back whenever the receivables start paying the company. In this case, the customers would pay the company itself, because the receivables is still the sole responsibility of the company. So the collection has to be done by the company. And as and when it's collected, the loan is repaid. So it is called a self-liquidating loan sometimes. Okay. So that is how an assignment takes place. So this is a case of an assignment of receivables or pledging of receivables, where the receivables act as a collateral. Now let me just demonstrate to you factoring, and you will see how it lightens the balance sheet. That's why it's called off-balance sheet financing, and the company has to give details about this in its annual reports, in its notes to the accounts, if there is any off-balance sheet transactions. Why is it off-balance sheet? So initially, there was AR of 100. The company now, does not put it as a collateral, it sells it. Sells it to a factor. So now the factor would have the AR, and the collection from the customers will be to the factor. Okay. So now what happens is the company doesn't have to show the receivables. It de-recognizes the receivables. So I rubbed it off. And instead of that, the factor would give the company cash. But he will not give them full cash. As I showed you previously, there are several deductions for interest, for factor fee, for factor reserve, etc., etc. Okay, so let us say the company gets only 90. Okay, company gets only 90. That 10 loss is a loss due to factoring, and it would be featured in the retained earnings. It first goes to the income statement and then it's close to retained earnings. And you would have 90 and 90 on the assets and liability side. Receivables is 0 because it's fully de-recognized. See, the balance sheet is so much lighter than in an assignment or pledging, where the total of the balance sheet is 195 and 195. I hope you understood this very clearly now, the difference between factoring and pledging. And in the case of a factoring, the seller surrenders all control. That's very important, that the seller surrenders all control to the factor. The factor can do whatever he likes with his receivables. He can even further pledge it, right? And none of the creditors of the company has any claim over these receivables. Only then a sale is said to be taking place, and the company can de-recognize its receivable and put it off the balance sheet. So it's called off-balance sheet financing. So this is the concept about factoring, with recourse, without recourse. We will do some multiple choice questions and try to understand it. Where part 1 is concerned, it's not of great importance. In the sense, it's not been tested quite very often. However, in part 2, corporate finance, it is tested, but we will not take any chances. Know the concept. Once you know the concept, it's very easy to solve the questions. So let us go on to the multiple choice questions on factoring in the next session. Hello everyone. Welcome to the lesson on MCQs on factoring. So let me share the screen and go to the question bank directly. So this question would help you to understand the entire factoring transaction. Pause the recording, try to solve it by yourself, and then look at the explanation. So here, the financing company, this is the factor. This finance company is called the factor, requires an 8% factors holdback. So the firm who often factors or sells his accounts receivable is going to a factor which holds back 8% for merchandise returns. Okay, this is mainly for merchandise returns and charges a 1.5 factors fee. This is his service charges on the amount of the receivable, original amount of the receivable. The remaining amount to be advanced, so the money is going to be advanced here, is further reduced by an annual interest rate of 16%. Remember, this rate is annual. What proceeds, rounded to the nearest dollar, will the company receive from the finance company at the time a 110,000 account, that means receivables worth 110,000, is sold and is due in 60 days. Okay, so assuming the selling firm withdraws the full amount of cash available immediately. Okay, sometimes, as I told you while explaining about factoring, the factor does not advance the entire amount in the beginning itself. It would first collect the receivables and then transfer the amount. So then they would charge a factor fee, no doubt, but they wouldn't charge interest. But then what's the benefit for the company if they are not going to get cash immediately? In such cases, the company still benefits because the responsibility and the work of collection and sometimes the credit losses, if it is without recourse, is transferred to the finance company. So even if they don't get immediate financing, companies would still go to factor their receivables for the sake that they would be handing over the responsibility of collection to the factor. In fact, they're outsourcing the collections work to a factor, right? So, and also they would save money. Company would save money in credit collection charges, right? The cost of follow-up for the receivables would be saved by the company. Okay, now back to this question. Let us calculate the amount to be transferred, or the firm, what amount of cash does the firm get from this 110,000 AR. From this 110,000 AR, 8% is a holdback for sales returns. Holdback, 8% works out to 8,800. And then there is a factor fee for his service of 1.5% on the original amount. So original amount, 110,000 into 1.5% is 1,650. And what is to be advanced? 99. So 110,000 minus 8,800 minus 1,650 is 99,550. Now, this amount should be given to the company, but there is an interest. It's further reduced by the annual interest charge. So they are deducting the interest and then giving the net proceeds. So 16% of this is 15,928, but this is for a year. So assuming the year has 360 days, we would divide this by 360 to get the daily charge. The daily charge is some 44, the charge per day is 44.244. This into 60 days, because the company is in fact advancing the cash, giving the cash in advance before it's collected, which otherwise would have taken 60 days to collect. So into 60. That would give us 2655 approximately. So that's the interest charge. 2655. And the net amount 99550 minus 2655, 96,895 cash would be given to the company. So C is the right answer. Now let me show you the entry for this. The accounting entry in the seller's books, not the factor, but the seller's books, the firm in this case. So now what would be the entry? Try to do the entry by yourself and then look at my explanation. So it is debit cash 96,895, debit factor fee 1650, debit interest charges 2655, debit factor receivable or factor holdback. I'll put it as factor reserve. It's called by several names, 8,800, and credit AR. The accounts receivable would be fully derecognized, removed from the balance sheet. Just check with whether all the debits and the credit is equal. That should be equal. Okay, so this is the entry. Now the cost of factoring is this much, because this will be the loss to the company. They would never get this money back. That's how much. Sometimes a question might be asked about what was the cost of factoring. And sometimes they would ask it in percentage as well. Okay, so you should be able to say that. So 4305. 4,305 is the loss due to factoring. This would hit the income statement. This would not hit the income statement because it's an asset, it's a receivable. If there are no returns, the factor would return back this entire amount. So that's about this question. Now, let us go on to another question. Here we go. Here, this is a question about pledging as a collateral and factoring, the difference basically. They say A, the lender has recourse to the manufacturing firm under factoring. Yes, it could have a recourse, or it needn't have a recourse as well. There is factoring with recourse and without recourse. And in the case of factoring, he is not called a lender because he's not lending money. He's actually buying the receivables. So that term there is not very correct. But he says that there is no recourse under assignment of accounts receivable. That's entirely wrong, because in assignment, the receivables are collateral. So if the collateral is bad, the lender would surely come back to the manufacturing firm and demand his money. And in this case, in the case of assignment, it is rightfully called a lender. So anyway, in any case, this is wrong. B, the factoring of accounts receivable provides a collateral for the manufacturing firm, whereas assignment provides direct financing. It's actually the other way about. Factoring provides direct financing, and assignment provides a collateral against which the firm borrows. So this is not correct. The assignment of accounts receivable involves the invoice from the manufacturing firm to its customer being stamped with the notification that the payment is to be made directly to the other party. No, that does not happen in assignment, but it happens in factoring. So this is also the other way about. So then D has to be the answer. Factoring of accounts receivable involves the invoice from the manufacturing firm to its customer being stamped with a notification that payment is to be made directly to the other party. I have explained this when I was explaining about factoring. This is called factoring with notification. Sometimes they're not even notified, but most of the time they are notified. In my experience, we were notified when one of our suppliers factored our receivable to another factor, to the bank, in fact. Whereas the assignment of accounts receivable does not require a notification or stamping of an invoice, because it is the firm's responsibility to collect the receivables and to pay off the loan which it has taken. So D is the right answer. Let us go to one more question. In this question, Woody Company sold or factored its 150,000 of its accounts receivable without recourse. So the credit loss is transferred to the purchaser. The purchaser assists a finance charge of 5%, which is his factor fee actually. Right? Woody should record a debit of cash of 150,000. He will not get the full amount of cash. And we don't know whether the cash is advanced, because sometimes factoring takes place without cash being paid immediately or upfront. It will be paid after the accounts receivable is collected. But in any case, the company would not get the full cash. Credit to accounts receivable of 150,000, this answer is correct because the entire receivables would be derecognized. A credit to a liability on transferred accounts receivable of 150,000, this is in a case of assignment or pledging. And even then, they wouldn't get the full amount as a loan. So this is not correct. Interest expense of 7,500. Actually, he has calculated 5% on this. 150,000 into 5% is 7,500. This is a factor fee, not an interest expense. And interest expense, if it was interest expense, they would have told 5% per annum, and they would have given the amount of days the receivables would get collected. So in this case, it's not an interest expense. So interest expense, if the cash is advanced, would be lesser than this because it would be generally for less than a year, right? So B is the right answer. This you can be sure of. So with that, we finished factoring, the explanation, and the multiple choice questions. As I told you earlier, it's not very often tested in part 1, but we are not taking any chances. But it can be tested in part 2, corporate finance. In any case, even as professionals, you need to know the concept of factoring, because you might negotiate with the bank or any other factor for a factoring a transaction. Hello, everyone. Welcome to the class of inventory. Now, let me just show you what we are going to study in inventory. So I would take you to a tour of the Hawk text for you to understand what you're in for. So inventory, basically, the first thing you should know is, in a manufacturing concern, inventory would consist of raw material, work in process, and finished goods. So it would actually form a big part of the balance sheet, value-wise. So it is, as he has told here, is a critical asset and one of the most important and possibly the greatest items on the balance sheet. Unless, of course, it's a just-in-time inventory system where they keep minimum inventory. So there's a lot of things to be known here, as well as the accounting is quite deep. So what do we do first? First we do is the valuation of the inventory, when it is purchased and how it is recorded. What are the amounts you would include in inventory? And then determination of specific inventory items for the year end. Example being consignment stock, whether it should be included or not, and some inventories which are free on board shipping point, FOB shipping point, or FOB destination. How do you account for them? How would you show them in the balance sheet? Would you include them or not? So all those things you'll be studying. And then the recognition of permanent declines in value of inventory. So this is write down of inventory. And it would depend on the cost flow assumption, which is followed by the firm, whether it is LIFO or FIFO. So now comes the next topic, that is the cost flow assumptions that you would study. So you are going to study basically LIFO, FIFO, weighted average, and specific identification. So here they are recording the inventory and what are the items to be included, any discounts, etc. All that should be shown. And what are the goods included in the inventory, in transit, consignment, on approval, FOB shipping point, FOB destination. All this I will be explaining in great detail. So this is just a tour. So don't think that this is my explanation. I would go very deep in each of these. And then consigned goods, whether to include them or not, right? And what amount to include. And goods sent on approval on a sale or return basis. How is that accounted? And then obsolete inventory. Should you show it on the balance sheet or not? It should be written down. So how you would write it down, right? So all that you will be studying. And yeah, inventoriable costs. That is what are the costs going to be included in the inventory, like freight charges, customs duty, or import duty as they call it, and so many other things. And the cost flow assumptions, the FIFO, LIFO, average cost, and specific identification. With a note here that IFRS does not allow LIFO. And the benefits of FIFO and limitations, and benefits and limitations of LIFO, etc., etc. So all the other cost flow assumptions would also be studied. Then LIFO under the periodic system and FIFO under the periodic system. So all the cost flow assumptions under the periodic and perpetual system would be studied. First of all, you will have to understand clearly how periodic system works and the perpetual system works. And after that, we are going to study how it would behave. I mean, how the cost would flow in periodic inventory system under the FIFO assumption, LIFO assumption, weighted average, moving weighted average, etc. You'll also learn about LIFO liquidation, which is a very important concept. And we are not done yet. Then physical inventory count. US GAAP suggests that a company should undertake a physical inventory count at least once a year. So as of year end, it is generally done. And then if anything is missing, when you compare it with the books, once you do the physical counts, you would compare it to the books and then write off the inventory after investigation. If it's found missing, of course, the proper investigation is done to find out why it was missing. And then later on, you would write it off by debit inventory loss and crediting inventory, therefore removing it from the records. Other way also is possible. You debit inventory and credit inventory gain. This would happen when a supplier has actually sent an inventory item twice, and there's no way of returning it, or returning it would be very costly. It happened to us one time by a company in my workplace. A company sent a Xerox machine, a photocopier from Xerox, sent the machine twice, in the sense, two numbers instead of one, what we had ordered. And we found out that to return it would be a laborious process because it came from out of the country, it was imported. So that would be more costly. So what we did, we kept that machine. Okay. And later on, we just informed the supplier also that they have sent it twice. So in that case, we had to make this entry. And then later on, instead of gain, we credited the supplier and then later on adjusted it from future payments to the supplier, right? So we didn't want it, but still we had to keep it because returning it would have been very expensive. Then errors in inventory. Now, sometimes some inventory items are counted twice and mistakes have happened. Sometimes it's overstated. So what's the effect of these errors on inventory? So that's what we will study, and a lot of multiple choice questions on this. And yes, these are the permanent decline in values which I was talking to you about, whether it will be lower of cost of market or lower of cost or NRV. It depends. NRV, by the way, is net realizable value. It all depends on the cost flow assumption. I will go into that in greater detail. And yeah, what is the effect of having the cost flow assumption as LIFO and how it would affect the tax reporting, the LIFO conformatory rule, in other words. Right. And how will you record the write-downs in inventory, whether you would debit a loss account or would you debit a cost of goods sold account? So that's how, those are the choices we have. And with a very good example, difference between IFRS and US GAAP where inventory is concerned. And then we go on to investment. So this is the entire inventory topic. Let us deal with it one by one. Hello everyone. Welcome to the class on inventory. In the last class, I discussed about the topics that we are going to study for this inventory lesson. So now I will start up on one of those topics, which is the shipping terms. I'll just get you familiar with shipping terms and when to recognize inventory on the balance sheet, right? So the main terms that we study about is FOB shipping point and FOB destination. Now just I will explain what does all this mean. Okay, I'll explain it with the help of a drawing. Okay, so let us assume that this is the supplier. I'll just put it in a proper way so that I can demonstrate properly. Yes, this is the supplier's factory. The vendor. Okay, this is the supplier's factory. And let us say on this is the buyer's truck. Okay, and the buyer takes the goods directly from the supplier's factory. Okay, and this happens on, let us say, 25th of December, right? And then later on, it's the buyer's responsibility for inland transport, inland freight, and then later on, he puts it on a ship. The goods are on the ship, and this happens, let us say, on 30th of December. And the buyer looks after all the import formalities. Export formalities, because the supplier is basically exporting the goods, but it's taken by the buyer from the factory itself. So it's called, the term given to that is ex works, right? And he looks after the export formalities. Then when it comes to his country, he looks after, on the way, insurance, all the buyer's account, insurance, freight, right? So all this is looked after the buyer. Then he would pay the import duties at his country, and then takes it to the, looks after the inland freight also, and takes, this is the buyer's factory. This is the buyer. So now if the buyer is going to recognize inventory on the balance sheet and the terms is X works, when should the buyer recognize it on the balance sheet? So for the year ended December 31st, the buyer would definitely show it on the balance sheet, because the title of goods and the responsibilities, risks and benefits of the goods which he has purchased is transferred on 25th of December, when the buyer takes responsibility of the goods and looks after all the other formalities and expenses from there. So the risks and benefits have been transferred to the buyer at this point. So the buyer can recognize the inventory on his balance sheet on 25th of December. So by year end, he should be reporting these goods, the value of those goods, right? Now, let us say it is not Ex Works. Okay, so it now becomes the seller's responsibility, the seller, or when I say supplier, I mean seller as well. Let me use the word seller better. So the seller responsibility to take the goods. Okay, by the way, let us say that the buyer receives the goods. The goods are here in the buyer's premises on 5th of January the next year. Okay, now coming to this, so the seller puts the goods on the truck, takes it, looks after the export formalities, and puts it on board. Okay, pardon my drawing, right? Puts it on board of the ship. So this is the shipping point. And it is called FOB shipping point, because the seller looks after all the expenses up to this point. And after that, it becomes the buyer's responsibility. All this is the buyer's responsibility. Right? Insurance, freight, and import duties, etc., would become the buyer's responsibility. So, can he recognize these goods as of 31st of December? Can the buyer recognize these goods on his balance sheet on 31st of December? The answer is yes, because the title of goods and the benefit and risks of ownership got transferred to the buyer on 30th of December. So if it is FOB shipping point, the title gets transferred at the shipping point. But until then, it's free on board shipping point. It's free for the buyer until the shipping point, because the seller looks after all the expenses until then. But saying free is sort of a misnomer, because the seller would definitely include all his expenses with a markup on his invoice. But it may not be as a separate line item. It would be a part of the price of these goods. So yes. So what's the takeaway here? At shipping point, FOB shipping point, the ownership gets transferred and the buyer can recognize these goods, the value of this inventory on his balance sheet as of 31st of December. Now, there is one more thing. Let us say that the seller is going to look after everything. Okay, so just let me erase one more thing. It is I will remove this. Okay. Now seller would look after the export facilities, export formalities. He puts the goods on the ship, looks after the freight, insurance. This is all seller. From here, it's all seller. And even the import goods. And if he, this is also seller responsibility, inland freight. And if he brings it to the buyer's doorstep on 5th of December, this is called, the term is called FOB destination. In which case, the title of goods gets transferred to the buyer only on 5th of January of the next year. So, as of 31st of December, the buyer will not be able to show the goods on his balance sheet. He would not show it on the balance sheet. So he would actually recognize the goods and recognize the liability to the seller on 5th of January in the next year. So when we're talking about recognizing the inventory value on the balance sheet, we are also talking about showing a liability for the cost of those goods, right? And the liability is to pay the supplier, right? So this is FOB destination, and that means that goods gets transferred to the buyer as of 5th of January when it reaches the destination of the buyer. So until then, it will be the seller's responsibility. I hope you got these concepts correct. And now, with the help of these, we'll put it to action. We would solve some multiple choice questions to get these concepts correct, right? Hello, everyone. Welcome to the class on inventory. And we spoke about the shipping terms, FOB destination and FOB shipping point and Ex Works in the previous session. So now we would do multiple choice questions on those. Let us go on to the screen of multiple choice questions. Yeah, this is the first question. Like I always tell you, please pause the recording. Try to do it yourself based on what I have discussed in the previous video. And then after that, look at the answer and my explanations. So Uh, Here he says the following items were included in the company's inventory account on 31st of December 2005. Merchandise out on consignment at selling price. So what you are seeing here is selling price. And 40% of the selling price is the markup. In other words, there's a 40% gross margin. Goods purchased in transit. It's still in transit. Shipped FOB shipping point at purchase price was 36,000. Goods held on consignment by Opal is 27,000. So here, just please pay attention to what the question is. By what amount should the company's inventory account be reduced? How much you should reduce from the inventory account for its 31st December balance sheet, right? Please note that he has told you the following items were included. So how much should be excluded? So when he has sent the goods out on consignment, it still belongs to the company, Opal company, because he has not sold it. He has just given it out on consignment. The title of goods or ownership still is with Opal. So actually, he should include this. It's rightfully included in his inventory, but it should not be at selling price. What he has told here at selling price, that's not correct. So you have to minus 40% of the selling price. Okay, so you will minus 16,000. So 40% of 40,000. You will, because he has asked you by what amount it will be reduced. When these are included, it should be reduced by the gross margin, because you don't carry inventory at selling prices. We carry it at cost or market, whichever is lower. So here at least we'll arrive at the cost, and then they would test it for other things like lower of cost or market. Okay. So here the amount which has to be reduced is 16,000. The gross profit certainly should not be included. Goods purchased in transit, shipped FOB shipping point. So now in the previous video, I told you that if it is shipped FOB shipping point, at the time of shipping, the ownership gets transferred to the buyer. So since it's in transit, it means it's already shipped. And 36,000 should be included in the inventory. Okay, so it's rightfully included. Nothing to be reduced here. Now, goods held on consignment. Now, these are other companies' goods which Opal is holding. It is not a part of Opal's inventory. So he just takes responsibility of holding these goods on consignment until it is sold, right? It does not belong to Opal. So it has to be reduced. So these two amounts has to be reduced, and that comes to 43,000. So D is the answer. 36,000 does not have to be reduced. It's been carried at cost, FOB shipping point, but it's still in transit. They have not yet received it, but still they should be recognized, or it should be included in the inventory. It can be included as goods in transit, and that's also a part of inventory. So now let us go to the next question on these concepts of FOB terms, shipping terms. So let me just go to it. It is 1.08. Again, pause it, try to answer it, and then look at my explanation. Now, here, he is using a perpetual inventory system. I have to still explain the concept of perpetual and periodic, which I would do in the coming sessions. So he has actually sold, the wholesaler has sold and shipped goods, but FOB destination on 31st December. The goods will reach January 3. At the end of 31st of December, the merchandise inventory totaled 2457 for the wholesaler before any adjusting entries. So in other words, this 2457 would not include this 80,210 because it's already being shipped. They have to now make the adjusting entries to this. And also it says that this balance excludes the following. Right? It excludes the following. Now we should decide whether it should be included or not. So now the 31st December inventory is this much. He would have already, at the time of it being invoiced or sold, that time this inventory is not there. So he would have excluded it. So now you have to include it. Why are we including it? Because the title of goods would remain with the seller if the terms are FOB destination until it reaches the destination. So the ownership of these goods are still with the seller, the wholesaler in this case. It would remain with the seller until January 3rd when it reaches the retailers. So as of 31st of December, you're certainly going to add it. The wholesaler is expecting 75,330. It was shipped on 31st December shipping point. So at that time, the ownership would have got transferred, but it will arrive on January 2nd. Doesn't matter because the ownership transferred on 30th of December. And he says it excludes, we have to include. Maybe include it as goods in transit. And then in the existing inventory, it was determined that 20440 is obsolete, cannot be sold, has no scrap value. And yeah, right? So he is saying that in the existing inventory, this is there. Okay, so then it has to be deducted because we cannot show the value of something obsolete will be actually overstating the inventory value because it cannot be sold. It has no scrap value. So it's a total loss. It has to be removed. So if you do the math for this, you are going to get D. So with this two questions, I hope you got the concept of FOB destination, FOB shipping point, and consignment goods concept. I've explained it here. So if you have a question on this, you can ask me during office hours. So now, with this, we end this session and we'll go on to other concepts in the next one. Hello, everyone. Welcome to the lesson of inventory. And now we will discuss perpetual and periodic inventory systems. Now, the best way to explain perpetual and periodic inventory systems is to go to a question, go to a multiple choice question and solve it. And while solving it, I will explain the concept of perpetual and periodic inventory system. So let us go to the question. So now here it says that Jensen uses perpetual inventory system. The following purchases and sales was done during the month. And the question is asking if he uses the FIFO method of inventory valuation. The 31st May inventory would be what? What would be the value of inventory? Now, FIFO, LIFO, weighted average and specific identification are cost flow assumptions. Now, what do I mean by this? Now, just let me go to the whiteboard and explain the concept of LIFO and FIFO first. And then we would come back to that question. Okay, now let us assume that there are two layers of inventory. One purchased on 1st of Jan. Quantity is 1. I'm going to make the example very simple. And amount, okay, before that, quantity is 1. And price per unit is, let us say, 10. And the amount is 10 itself. And then there are on 3rd of Feb, let us say, on 3rd of Feb, there were 1 unit at 12, purchased at $12, assuming that there was a rise in prices, and that would become 12. So I'm making the example quite simple here. And let us say they sold 1 unit at, let us say, 25. So the sales price would be 25. And if it's a FIFO system, the first in goes out first. So that's the assumption. Physically, it might not go out in that manner. But we are assuming for generally homogeneous goods that the first arrival is going out first. So that one cost would be 1 at $10. 10. So COGS is cost of goods sold, and that would become 15. The gross profit would be 15. And similarly, if it's a LIFO system, if it's a LIFO inventory assumption, the last in would go out first. Assumption. Physically, something else might happen. Physically, generally, people want to get rid of their first arrivals because that would be the oldest inventory. They want to get rid of that physically. But the cost records or the financial records would show that the last in is going out first. That's the assumption. So this would go out at 12. And we would have 13 as gross profit. If you remember previously, it was 15 gross profit. Now the gross profit has reduced. And the company following a LIFO method would generally report lesser incomes in an inflationary economy where the prices are rising, and therefore would pay lesser taxes. Since they would pay lesser taxes, if they use LIFO for tax accounting or to show the tax returns or to arrive at the taxable income, if they show LIFO, they are obliged to use LIFO for their financial reporting as well. That is the LIFO conformatory rule. There is no such rule if the company is following FIFO, weighted average, or any other method. But under LIFO, if the company is following LIFO, the LIFO conformity rule says that if you're following LIFO for tax purposes and showing lesser income and paying lesser taxes, you cannot show a rosy income, rosy picture in the financial books and show the shareholders that you're doing very well. So you are obliged to show LIFO in the financial books as well and show the same lesser profit. So this would be a LIFO system. And what is a weighted average? Now, weighted average, what would happen is, now there are two quantities. two quantities. The price of this is $22, and the average price is 22 divided by 2, which is equal to 11. So this would become the average price. And this is the price at which the goods are assumed to be sold at. So suppose they sell one good, one of these items, it would go out as 11. And yes, 11 would get deducted. So actually, what would happen is COGS, one item at 11, right? That would be your COGS, and the profit is going to be 14. Okay, so if you analyze, the profit under FIFO was $15 gross profit. Under weighted average, it was $14. I'm sorry, $14, as you can see just now. And under LIFO, it was $13, if you remember correct. So weighted average is a golden mean here. It's in between the LIFO profit and the FIFO profit, right? And the inventory would now be, the balance in the inventory would be 1 unit at 11, which is $11. Yeah, so that's how it would be. Now, specific identification actually happens when there are large goods, large capital items. They are in where you cannot take an average of the cost. Let us say the company is selling helicopters. Pardon my drawing. Right? Assuming this is an helicopter. Right? And this is, let us say, $3 million. And there is one more in the yard, right? The same model, same type of helicopter, but probably purchased earlier. And this is, let us say, 2.5 million. There's one more helicopter. Okay, we have to put that. Okay, right. So this helicopter, let us say it is purchased sometime. It is 2 million. So let us say this one was purchased in 2022. This purchased in 2018. And this one was purchased in 2015. Right? The same kind of helicopters. Right? So only because of the purchasing in different dates, this is the latest. So it would cost more. Now, if a person sells a helicopter, right? Let us say all these are the same helicopters. So you're selling it for, let us say, $5 million. You sold one for $5 million. Now, you would specifically identify what the customer has taken, what he has chosen by serial number. So if he chooses this one, then your COGS is going to be $2 million. If he selects this one, it would probably be $2.5 million. And similarly, if you select this one, it would be 3 million. So it's specifically identified and goes out by serial numbers. You are not going to use an assumption here. We are not going to use a FIFO or LIFO, or you are not going to take the average cost of all the helicopters here. Specifically identified because the customer probably would customize some of the helicopters, which would cost them more, but they would modify it. And so the modified cost should be going out as cost of goods sold. So this is about all the cost flow assumptions, right? And based on that, on these assumptions, we would actually follow the FIFO, LIFO under the perpetual and periodic systems. Let us discuss that part in the next session. Hello everyone, welcome to the lesson of on inventory and about perpetual and periodic inventory systems. In the last session, I started off explaining perpetual and periodic inventory systems, but then I thought I should first explain the cost flow assumptions, that is LIFO, FIFO, weighted average, and the specific identifications. I explained that, and now I would explain LIFO, FIFO, weighted average under the periodic and perpetual inventory systems. Now, what is exactly periodic and perpetual? Like the name suggests, a periodic system would actually determine the balances for a period, the inventory value for a particular period, and then from that, the cost of goods sold figure is determined. In a perpetual, like the dictionary meaning says, perpetual is continuous. In a perpetual system, which is more sophisticated and requires more sophisticated facilities, the inventory balance is determined continuously, not at a period, not for a period, but continuously as and when sales or purchases takes place. So inventory records are updated perpetually or continuously, and at any point of time, we would know the cost of goods sold, the sales, the cost of goods sold, and the gross profit. So that is how it works roughly. But let me just explain the concept to you with the help of a question, then you would be able to understand it better. Now, here is a question. And he says that it uses perpetual inventory system. Jensen uses perpetual inventory system. The following purchases and sales were made during the month, and he uses FIFO. And they're asking us to find out the 31st May inventory balance. Now, actually, it doesn't make a difference if you use perpetual or periodic where FIFO is concerned. But let me just explain the concept here of a perpetual system. Now, in a perpetual system, what happens is the inventory balance. Now, this is the balance, right? So here comes the balance. I'll put it here. Balance of 100 at 10. No need of multiplying it. Just leave it as it is. Then on 9th, this is the first balance. On 9th, a purchase was made. So it adds to that 200 at 10. I'm just showing you the perpetual system. Then I will show you the periodic. So the perpetual, again, the balance is continuously updated. So now you have got 300. I've not multiplied it at this stage. Then I will show you a sale. Now, when a sale takes place, sales of 190, it would go based on the first in, first out basis. So 100 would be priced at 10. That would be the COGS. And 90, the remaining 90, would go on from the next layer, which is also 10. Okay, so then what are the layers after this? After this, we have 100 has gone out fully. We have got from here 110 at 10. That is the layers remaining. Now, let us say there was no, according to the question, there was a purchase. On 21st, there was a purchase of 150 at 12. Obviously, prices are rising. And on 29th, there was a sale of 120. So the 120 sale would go at 110 at 10. And the extra 10 would go from the next layer, because this is FIFO system. So first in, first out. The extra 10 will go in from the next, which is 12. So now the balance is that 110 is fully gone. You have 140 at 12. And that's what they want, which is equal to $1680. So D is the right answer. So in perpetual system, we are continuously updating the records. In a periodic system, we don't do that. We don't do that. In periodic system, the sales is recorded, but the cost of goods sold is not until the period is over. And then we determine it. We would determine what would be the cost of goods sold and the inventory balance at the end of the period. Right? So now let us talk about, now this is the inventory balance, the closing balance, which would be taken into the balance sheet. Now, what about the COGS? The COGS is actually in this column. So if we do a quick math, we can get the COGS also. The COGS would be 110 at 10 is 1000 and 90 at 10 is 900. So 1900 here. Don't get confused, it's not a purchase, it is the total of this. And here 1100 plus 120, 1100 plus 120 is 1220. So the cost is 1900 plus 1220. So how much is that? 1900 plus 1220. So the cost is 3120. Right? 3120. See here, one thing you should notice, I'm doing more than what they have asked you, just to explain the entire concept here. So even you can find out all this by finding out the opening stock, which is the balance brought forward, the opening balance plus purchases. How much is that? The opening balance is 1000. So I'll put here opening balance is 100 at 10, which is 1000. And all purchases, this is 200 at 10. So purchases would be purchases. I'll put here purchase 200 at 10, which is 2000. And let us forget the sales for the moment. Just talk about purchases. Then there is a purchase here again. 150 at 12. 150 into 12, which is 1800. So these are the items available for sale. That is 4800 is available for sale. Right? And now if there is only 1680 remaining under the FIFO system, this is the closing balance. So opening stock plus purchases minus closing balance should give us the cost of goods sold, because they had this much available for sale. But now at the end of the period, they're having only 1680. So it means that the remaining they have sold. So 4800 minus 1680 is equal to 3120, which is the same figure which we got here. Right? So we used the FIFO closing balance and minus it from the goods available for sale to get the COGS under FIFO. To get COGS under FIFO. So now you saw the FIFO perpetual system. It's continuously updating the records as and when a sale or a purchase happens. Now I would like you to remember these figures. The closing inventory is 1680 and the COGS is 3120. Just make a note of that. Then I will talk about the periodic. Under the periodic, as you saw before, the closing stock is 140 units. This is the closing balance. So how do they determine the inventory balance? The assumption is the earliest prices have gone off and the latest prices would remain. So actually, what we are trying to say is the last layer would remain as the earlier layers are sold out. So if the stock is 140 units, this would be priced at the latest prices. This is for inventory valuation. So the latest price is 12. We get the same thing under FIFO perpetual or FIFO periodic. And if you want to know about the cost of goods sold, how much they sold? They sold 190 and 120 units. So 190 plus 120, under 310 units was sold. Under the FIFO periodic, we are not bothered about the timing when it was sold. Okay, so they sold this much, they sold it at the earliest prices. So 100 was sold at 10, then 200 was also sold at 10, and another 10 was sold from this layer, right? Because the earliest layers should be finished and then we come to the later layers. So 150 at 12 it is. So here 300 is accounted for, the remaining 10 goes at 12. So this would be the COGS. Now how much is it? $1,000, $2,000 and $120. If you remember, we have the same COGS 3120. So this shows us that FIFO, periodic and perpetual, gives us the same balances because whatever you sell at whatever time, the earliest layers is assumed to have gone off. So the timing is not so important in FIFO. So FIFO perpetual and FIFO periodic would give you the same closing balance and the same COGS. In a periodic system, we would see in the end how much stock we have and value it at the latest prices because it's assumed that the earliest prices have been sold. And for COGS, you take how many units we have sold and value it at the earliest prices, not the latest, because first in is going out first. So that's the assumption. And FIFO periodic and FIFO perpetual gives you the same result because whenever you sell it, the first units, the first layer is going out as COGS. Okay, so that's why it gives you the same figure. It doesn't, the timing of when you sold it doesn't matter, right? But under the LIFO, the timing is important. When you sold it gives you a different result under perpetual and periodic system. We would see that also, but I hope now you got the FIFO part well understood. And we would talk about the LIFO in the next session. Hello everyone. Welcome to the class on inventory, and we were doing cost flow assumptions. So in the last session, I explained about FIFO under the perpetual and periodic. And I showed you that FIFO gives the same cost of goods sold and closing inventory, ending inventory balance in both perpetual and periodic, right? So now let us study about LIFO, periodic and perpetual. Now that will not be the same. The results under perpetual LIFO and periodic LIFO would be different. So let me just share the screen and then speak about it further. So as you can see here, this was the question we spoke about yesterday in the last session. And you see in FIFO, what happens is, if you sell it maybe on 8th of May, still, if you sell something on 8th of May, still this topmost layer, the earliest layer would go out. Or if you sell it even on, let us say 29th of May, still you would have to finish the topmost layer. So the timing of the sale doesn't count in FIFO. That is why periodic and perpetual gives the same result, because periodic doesn't take into account the timing of the sale, right? So because what it looks at in periodic is it assumes all the earlier layers have been sold and the latest layers remain. Okay, so that would hold good in both perpetual and periodic in the case of FIFO, because the earliest layers are always going out first, no matter when you sell it, right? So in LIFO, that's going to be different, right? So let us look at the same question under the LIFO perpetual. So perpetual is more accurate. As I told you before, it takes into account the timing when the sale happened. Okay, so if you're going to do perpetual LIFO, like I'm going to show you now, in fact, this is a question also. Now, perpetual LIFO, I should have written it in capital. Anyway, you understand? I would write it in capital because it can cause confusions otherwise. Okay, so it is perpetual LIFO. Some people say LIFO, some people say LIFO. It doesn't matter. So on 1st of May, they had a balance of 100 units. This is the opening inventory at 10. Do not multiply, because we are going to find out the inventory valuation as of 31st of May under perpetual LIFO. Okay, not FIFO as they're told here, because FIFO was done in the previous class. So now, on 9th, there was a purchase. Maintain that layer, 200, also at 10. Then, on 16th, there was a sale. So the sale, I would put it here. It was 190. And which is the last layer? This is the last layer. So at 10. So now after this sale, don't multiply anything. This is how I work out. If you have easier ways of working out, please go ahead. So now let us maintain those layers and see what are the layers which remain. 100 at 10 would remain, but out of this 200, 190 has been sold. So you would have 10 at 10. Still do not multiply. Okay, because we'll multiply and find out the ending inventory as of 31st of May only, right? And then on 21st of May, they had a purchase. So one more layer gets added on, 150 at 12. And on 29th of May, there was a sale of 120 units. So that 120 units would go from the last layer, 120 at 12. So there was no LIFO liquidation in this question. What do you mean by LIFO liquidation? Supposing they had sold instead of 120, let us say 180, then 150 would have been costed at 12. 10 would have costed at 10 units would have been costed at $10. And out of this layer also, the balance would have gone. So when you sell out a full layer, you are said to have liquidated a LIFO layer, right? Liquidated means sold. So here they're not selling off a full layer. They sold 120 at 12 and in the last layer is 150. So let us look at the layers now. 100 at 10, 10 at 10, and out of this 150, 120 goes. So 130, I'm sorry, 120 goes and 30 remains. 30 at 12. Now multiply. So you would get 1,000 here. You would get 100 here. And you would get 360. So totally is 1,460 US dollars. So this would be the ending inventory as per LIFO periodic. In fact, they have asked you that question based on the same data. They have asked the question down here. If you notice, they have asked in question number 20 here. They have told you perpetual, last in, first out, method of inventory valuation, and what would be the 31st of May inventory. That's what they have asked you. Okay, the answer is B because we got 1460. So the answer is B. Now, if you do the same thing, under periodic LIFO, periodic is you are doing your costing or valuation of the inventory at the end of a period. Now, end of the period, the number of units is this much. Right? So the number of units is actually 140 units. Okay. So now 140 units, how are you going to cost them? We are going to cost them in such a way that we assume that the latest layers have been sold because it is LIFO, last in, first out. So we are assuming out of this that the latest layers have been sold and the earlier layers remain. So out of this, there is one layer here. We are assuming it to be 100 at 10 would be there. So that is $1,000. And the remaining 40 would go from here, right? That is also $10. So that is going to be 400. And LIFO periodic is going to be 1,400. LIFO perpetual was 1,460. LIFO periodic is 1,400 because periodic doesn't look into the timing when it was sold. Because you see here, this sale was assumed to have taken place and 12 was the last layer at that time. So here we are just assuming that whatever is remaining, whatever inventory is there, it is costed at the earliest layers because it's assumed all the latest layers have been sold. Okay. See, actually, what it's assuming here that how much units they sold. So they sold a total units of 190, 190 and 120. So 190 plus 120, 310 was sold at the layers. Like we have considered that this layer has completely gone. Whereas in reality, some of it remains under perpetual. But when you're talking about LIFO periodic, we are assuming from this 310 which we sold, 150 was at 12 fully, right? But in reality, it has not gone out fully, 30 remains. Okay, so that is why we are getting a difference between a periodic and perpetual LIFO. So this is the ending inventory under periodic LIFO, not FIFO. Okay, and this is perpetual LIFO. Okay, so with that you understood the difference between periodic and perpetual LIFO and FIFO. And I repeat again, under FIFO, periodic and perpetual give you the same result. That is, periodic FIFO and perpetual FIFO gives you the same ending inventory valuation as well as the same cost of goods sold. Whereas that is not the case with a perpetual LIFO and a periodic LIFO, as I have shown you and demonstrated it here. We'll talk about the other cost flow assumptions, that is the weighted average and the moving weighted average, in the next session. Hello everyone, welcome to another session on inventory. And today in this session, we will talk about perpetual LIFO and periodic LIFO, which we have already discussed in a question in the previous session. But here I want to show you two ways of arriving at the cost of goods sold under both the methods. And also I want to explain the concept or demonstrate the concept of LIFO liquidation. So let us go to the question directly. So pause it and try to do it. It's asking you LIFO perpetual inventory system, the inventory valuation as of 31st of March. Right. So I have a style of doing it, a particular method of doing it. If you have a better method, please follow it. So the opening balance on 1st of March, right? I would put balance here. He has put inventory. We'd maintain the layer at 3,200 at 64.30. Now the sales price which he has given here, for this question, it's not relevant at all. Okay, so we can easily ignore it. It's just an extra column there, right? And then on 4th, there was a purchase of 3,400 units at a unit cost of 64.75. As you can see, the prices are rising, become 66 later on. So it's an inflationary economy. And 14th, there is a sale of 3,600. Now I want you to watch carefully, pay attention here, because there's going to be a LIFO liquidation. So out of this 3,600, it means that we are selling out this entire layer and going to a cheaper, earlier layer. Okay, so whenever LIFO liquidation takes place in the event of rising prices, the profit is going to get inflated and you would pay more taxes. So 3,400 would be at 64.75, and the remaining 200 at the earlier price of 64.30. Don't multiply anything. Since they asked you the ending inventory, we multiply it only in the end. Now let us maintain the layers after this sale. What is remaining? Actually, 3,000. This is fully sold. So 3,000 at 64.30 remains. Right? And then on 25th of March, there is a purchase that adds on to the layer. It is 3,500 units at 66. Prices have increased again. And then 28th of March, there is a sale. And in this time, there is no LIFO liquidation because 3,450 would go from this layer and they have 3,500 there. So at 66. Right? And now what is the layers? The earlier layer is untouched, so 3,000 at 64.30. And out of this, 3,450 has gone, so there would be 50 remaining at 66. So at this point, we can multiply and get the answer. So if you multiply it, 3,000 at 64.30 would be 192,900 plus 3,300 would be equal to 196,200. So dollars. So A is the right answer. Now let us see how much is the number of closing stock, which is 3050 units. So 3050 units is valued at 196,200. How many units did they sell? If you total the units they sold, is going to be 3,600. 3,600 plus, you can even see it from here, 3,600 plus 3,450 would be 7,050. This is what they have sold. And how much is the value? You can just multiply all these and get the value. So it would be 3,400 into 64.75. Use memory keys, put it in memory. 200 into 64.30, put memory plus, and 3,450 into 66, put memory plus, and then recall the memory. You will get 460,710. Now, what I would like you to do is to remember all these figures, because I'm going to arrive at the cost of goods sold using a different technique. Okay, so remember how much is the figure of cost of goods sold, which is 460,710, the number of units sold, and also number of units in ending inventory and the value of it. So make a note of all this because I'm going to remove all this now and then show you a different way of doing it. So now we can get available for sale units. Now, what is available for sale? Available for sale is whatever they had in opening inventory plus all the purchases made. So that is, so this is, I would say, opening balance plus purchases. So how much would that work out? So if you calculate, it is 3,200 at 64.30 which is equal to 205,760. You can verify whether the figures are right. And then they purchased 3,400 at 64.75, and it is 220,150. And they made another purchase of 3,500 at 66. That's valued at 231,000. So the opening stock plus purchases comes to 10,100, and the value of it is 656,190. So these are the units they had available to sell. And the ending inventory under perpetual LIFO was, units would be the same, that is 3050, and it was valued at 196,200, if you remember correctly, because that was what was asked in the question, 196,200, and they would have 7050. You remember all these figures, right? And what is the COGS? The COGS is 356,190. I'm sorry, this is 910. I made a mistake. So 656,910 minus 196,200. So basically, this was available for sale, and now ending inventory, they are having lesser units and lesser amounts. So what it means they sold the remaining. And how much they sold it? It would be, cost of goods sold would be 460,710. It was the same figure we got by just straight away multiplying the units sold with the unit cost, it being a LIFO perpetual cost, right? So there are two ways of arriving at the COGS. One is taking the opening balance plus purchases and minusing the closing inventory or ending inventory as per the perpetual LIFO. The value should be as per the perpetual LIFO. The units would always be 3050. Okay, so that's one way. Now let us go to periodic LIFO. Now, if the same thing, if they had asked you LIFO periodic, what we would do is go directly to how much inventory is there. The inventory is 3050, right? This many units of this particular product, which is a carburetor. And this would be costed at the earliest layers, assuming that the latest layers have been sold. Okay, so this would be costed, the entire thing. In fact, 3,200 is the beginning inventory. So we're going to assume that this 3050, which is there, would be at 64.30 because it's less than 3,200. Okay, so we're assuming that the earliest layers remain, the latest layers are sold out because it's LIFO. So 3050, we are not bothered here about the timing of the sale. Into 64.3, we are getting a little bit different, 196,115. But under LIFO perpetual, we had got 196,200. Not too much of a difference, but that's how it is. Now, opening stock plus purchases would be the same. Okay, we got, if you remember, 10,100 units, and it was valued at 656,910. 656,910. So that's what was available for sale, and the closing inventory was 3050. So it's assumed that we have sold 7050, and the costing of this would be 196,115. So out of 656,910, 196,115 remains. And what's the cost of goods sold? The cost of goods sold would be 460,795. Right. And by the way, we can also try and arrive at it by another way, which is 7050, which is sold. This is the item sold, and we are assuming that it was sold at the latest prices. When we are calculating inventory as per the periodic LIFO, we are assuming that the earliest prices remain. But when we are calculating COGS, we would assume that the latest, it is sold at the latest prices. Okay, so out of this 3,500 was sold at the latest layer 66, and the balance 7050. Wait 1 second, this is COGS arrived at in a different way. So 7050 minus 3,500, the balance 3,550 is assumed to come from this layer, to be sold from that layer. So that is only 3,400. So 3,400 at 64.75, and the balance of 150 is assumed to have been sold from the earlier layer. So first we are selling everything from the latest layer, and then going back to the next layer, next previous layer. So now if you multiply and add it, let us see what we get. 3,500 into 66, put in memory. 3,400 into 64.75, put in memory. And 150 at 64.30, put in memory. And recall the memory. We are going to get the same figure, 460,795 as the cost. So there are two different ways of arriving at the cost of goods sold. I hope you have understood the logic of both, under both perpetual and periodic. And this example, you also saw LIFO liquidation happen when they sell 3,600 units and the previous layer was only 3,400. So they sell the entire layer and go to the earlier one. And in case of rising prices, you'll be going to the earlier, cheaper layer, and therefore profits get inflated and taxes will be paid more. So that's why companies always, during year end, they would accelerate purchases, and if it is inflationary, that would make the cost of goods sold more amounts in cost of goods sold, and that would reduce the profit. So companies do accelerate their purchases during year end. And sometimes they delay purchases during interim results so that it goes to the earlier, cheaper layers. So the earlier, cheaper layers are sold, cost of goods sold is less, profit is more, and they show the shareholders a rosy picture. This is not real good quality earnings. This is just manipulation, but companies do resort to it. So in the next session, we will talk about weighted average methods. Hello, everyone. Welcome to yet another session of inventory. And now we are going to talk about the weighted average cost flow assumption. So let us demonstrate it with the question itself. So I'll go to the question bank directly. So now here it is. The same question where we did LIFO, perpetual and periodic in the previous videos. And now they've asked you based on the same data to use weighted average periodic inventory system. Now, when they just say weighted average, it is associated with periodic inventory system. If they say moving weighted average, for example, if they say moving weighted average, it's associated with perpetual inventory system, right? So now let's talk only about periodic, and it's extremely easy. Now here, what we do is first get that average, what they're talking about. So the average cost, in fact, we did it in the previous videos, at least we got the figures which would help us get the average. For example, the opening stock plus purchases, that is the goods available for sale. From that, we get the average cost. How is that? 3,200, the beginning inventory at 64.30, which is equal to 205,760. And then 3,400, the purchases at 64.75, which would give us 220,150. And finally, this one, 3,500 at 66 would give us 231,000. So whatever they have purchased and the opening inventory, each one has a cost associated. What's the average cost? The average cost or the weighted average cost, you total this entire amount, which comes to 656,910, and the total amount purchased and what was available in the opening inventory is 10,100 units. Divide 656,910 with 10,100 to get the average cost. The average cost is working out to many decimal places, but we'll round it off to the second decimal place, 65.04, and we would use this average cost to account for everything. As you might have seen in the previous videos, that the cost of goods sold would be, the closing inventory. The closing inventory, the ending inventory was, if you calculate, if you add all this and minus the amount sold, which is 7050. What are the amounts sold? This one plus this one. It works out to 7050. Now, everything would be accounted at this average cost. So 10,100, which is available for sale, minus 7050 would give us 3050, the ending inventory units. This would be valued at 65.04 to give us 198,372, approximately. So 198,372. So that's what they asked you in the question. So in this question, that is what is asked. So the answer, as you can see, is C. C is the right answer. And we can also verify it again. Now 7050, the cost of goods sold. Okay, we can actually do this. 656,910 is the value of goods available for sale. minus what is left at the end of the year is 978,372. This is the cost of ending inventory as per periodic weighted average. So that means if you had available for sale 656,910 and now you have only 198,372, it means you sold the remaining. 656,910 minus 198,372 would give us COGS of 458,538. Just verify it because we have sold 7050 units. Now 7050 units into 65.04, because for COGS as well as ending inventory, you would be using this average cost, this weighted average cost for everything. So if you multiply 7050 into 65.04, 7050 into 65.04, which is rounded off, you get 458,532. Ideally, you should have the same COGS. There's a $6 difference. It is due to rounding off. It's due to rounding off. You take all the decimal places, you would arrive at the same figure, which we got by minusing from the goods available for sale. We minused the closing inventory to get the COGS. And here we multiplied the COGS, the cost of goods sold, the goods sold units into the average price. So there are two ways we arrived at the cost of goods sold. There is a slight difference here, and that is due to rounding off. So in the next session, we'll talk about moving weighted average, which is associated, as I told you, with the perpetual inventory system. Hello, everyone. So now we will be talking about moving weighted average in this lesson. The cost flow assumption, moving weighted average. We also did weighted average under the periodic system. Now, moving weighted average, as I told you earlier, is associated with the perpetual inventory system. So let us see how that goes. It's the same data which we used for LIFO as well as weighted average under the periodic system. Now we are going to use this for the perpetual inventory system, which is moving average perpetual inventory system. And we have to be careful to calculate the average cost rounded off to 4 decimal places. Only then we would get close to the answer which is suggested there. Again, this is totally irrelevant. The sales price is not taken into account at all for this question because we don't have to arrive at the profit. So now, what do we do here? Whenever a purchase is made, we need to be taking the average. And that average keeps moving because a new purchase would bring about a new average. And during my work experience of 25 years, whichever company I have worked for has always used moving average perpetual inventory system. I have worked for big companies, so it's always a computerized system and perpetual inventory system was followed. So they would take the moving average. I have not worked for any company which followed FIFO or LIFO. I have not worked. Of course, that doesn't mean it doesn't exist. People do have FIFO and LIFO in their work environment. So, moving weighted average is what we have followed in all the companies I have worked for. And most of the companies would follow the perpetual inventory system. Most of the public limited companies would do that. And now everything is computerized, so it's easier to follow the perpetual inventory system. Periodic inventory systems are generally followed by small establishments, small companies like bakeries or sole proprietorships. So now let's get on with the working of this. They have asked you the inventory value. So basically the opening inventory is 3,200 at 64.30. So you multiply it here, you would get 205,760 all in US dollars. And then 3,400. There's a different price. If there was the same price, we could have used the same average. But since there's a different price, it is going to be different price or unit cost. The average would change. So this would be 22,150. Together, just a minute. So together, it would be 6,600 and 425,910. 425,910. The average of this is dividing 425,910 by 6,600. You get an average of, since we had to round it off to 4 decimal places, it is 64.5318. You take a huge average. How did we get this? Dividing 425,910 by 6,600. Now we would use this average for the sale. Now 3,600 into 64.5318 would give us, this is a sale, by the way. So I'll write their sale and we're going to minus it from the figures because it's going up. 232,314. You can verify the figures simultaneously as they work out. So now this we will be remaining with 3,000 US dollars. And here the balance is going to be 193,596. I might have gone wrong somewhere. So you should be doing this and verifying my figures. Okay. Don't have to take the average again because the same average remains. A sale does not change the average, but a purchase with a different price of different cost per unit would change the averages. You can check it out. The same average would remain, which is 64.5318. Now they purchased 3,500 at 66, and that gave us 231,000. So this would have 6,500. And the total here is 424,602. We have a new average because a new purchase took place. The new average rounded off to 4 decimal places would be 65.3234. So you see, this process is a little laborious. So I very much doubt whether they would give this for the exam. But even if they give you the computation, it would not be many items. It would be a very few items because they would take time into consideration. So now I would suggest that you continue using this same average for the sale and then find out the closing inventory or ending inventory. Do that by yourself, just the one line. I showed you the entire process. You just have to continue in the same way to get the ending inventory. You would get close to this. May not be exact here because we have rounded off some figures. And of course, you can get very close to this figure. So C is the right answer if you continue and get it. Suppose you don't or you cannot do it. please ask me how to do it in office hours. If you have any questions regarding this, ask me during office hours. So now we finished all the cost flow assumptions under both periodic and perpetual inventory systems. We did FIFO, and we saw that periodic and perpetual gives the same results. And then we did also LIFO under periodic and perpetual. We did weighted average per periodic and moving weighted average perpetual. Specific identification, as I told you, is the goods or the cost of goods sold is specifically identified to the product which is physically moved out or which is sold. So with that, we did finish cost flow assumptions, but let us do a theory question. To get a better idea about perpetual and periodic systems. So here he says it's an auto parts store, it's a small retailer. A person called Tony Brown owns the business and has purchased a computer system equipped with barcoding devices. Tony Brown has asked Cheryl James, accountant, what she thinks of implementing a perpetual inventory system. See, it was a small place for small retailer. So they would generally use a periodic inventory system. And since they got a barcoding device, probably they want to track the inventory and adopt the perpetual inventory system. Which one of the following statements is correct? A perpetual inventory system is cheaper to administer than periodic. No, it's the opposite. In fact, periodic is more cheaper to adapt because you don't have to track each and every sale and account for the cost of goods sold. Cost of goods sold is done periodically, arrived at periodically. Only the sale is recorded. So definitely, perpetual system is more complex, so it will not be cheaper. And then they say that cost of implementing and administering a perpetual inventory system for a small retailer would probably exceed any savings generated from achieving better control. Perpetual inventory system, as I told you, gives better control because the cost of goods sold can be arrived at any point of time. We don't have to wait until the end. So, and it requires a computerized system, and here like barcoding devices, etc. So there is a chance, right? Would probably, it doesn't mean necessarily, would probably exceed any savings generated by achieving better control. This could happen. So B is the answer. Perpetual inventory system might eliminate the necessity of having to take physical inventory every year. That is very wrong. So even if you have a perpetual inventory system, book balance and physical inventory should be reconciled at least a year. That's what US GAAP suggests. So that's wrong. Perpetual inventory system requires daily reconciliation between goods sold per the cash, as per the cash register, and goods remaining in stock. It's not required for a perpetual inventory system, as inventory is automatically updated in the books. Okay, so a daily reconciliation is not required. A yearly reconciliation might be required. So for this, B is the right answer. It could wipe off the savings generated by achieving better control. But in most cases, it doesn't. It works very well. So in our company, we have been adopting the perpetual inventory system and moving weighted average. And it has better control. It gives us better control. And we don't think that the cost is a big issue, since we have very good control over the inventory. And at any point of time, we can just print the inventory account of a particular item and go to the warehouse and check the balances, because the inventory records have already been updated. And if we find a difference, we would investigate. So with that, we finished the inventory cost flow systems, but we are not finished with inventory yet. There's a lot more to do. We have to do the valuation. After adapting the LIFO and FIFO, we would compare with cost or market, right? So we'll go into that in greater detail in the next session. Hello, everyone. Welcome to the lesson on inventory. And we are going to do valuation of inventory now. Previous sessions, I had discussed the cost flow assumptions, the LIFO, FIFO, weighted average, and specific identification. So here you must know one difference between US GAAP and IFRS, which I have told you before, that LIFO is prohibited in IFRS. It's allowed only in US GAAP. And one more thing, the LIFO conformity rule, that if they are following, if a company follows LIFO for tax purposes, it has to also follow it for financial purposes as well, for financial reporting as well. So now, after this, after valuing it, after using the cost flow assumptions or adapting the cost flow assumptions, we have to value inventory. And how are we going to do that? Basically, why do we value the inventory? Why do we further do inventory valuation? The reason being that we don't want to show more assets. We don't want to overestimate our assets, which is inventory. So in order to do that, there are certain rules which we have to follow. Suppose the company is using FIFO, weighted average, or any other method other than LIFO and retail method, they would value the inventory at lower of cost or net realizable value. It is known as LCNRV. And if it is following or any method, any cost flow assumption other than LIFO, or retail, then it is going to be LCNRV. And if it is following LIFO or the retail method, then it is going to be lower of cost or market, subject to ceiling and floor, subject to certain rules. So I know at this point of time, everything seems Greek and Latin to you, because you really don't know what exactly I'm getting at, right? So, well, I will show it to you with a question, and then it would become more clear. It would become more clear. What do we mean by LCNRV? And what do we mean by LCM, subject to ceiling and floor? Okay, so what I would do is go to a question and demonstrate there. Okay, so here they have asked you to value the inventory. The amount that should be used to value tripods. He has asked about tripods. I will first show you with cameras. Okay, so I will just demonstrate what we mean by LCM and LCNRV in case of cameras. And then we would come to the real question, which is tripods. Right, so now the company uses LIFO cost flow assumptions to value its inventory. So that is what it's using. So in this case, we have to use LCM. Suppose instead of LIFO, if it was FIFO, we would have used LCNRV to value the inventory. Now, for just for a moment, let us talk about, just for a moment, let us assume that instead of LIFO, it's using FIFO or weighted average or anything, in which case it would be LCNRV, lower of cost or net realizable value. So now let us value cameras assuming a FIFO cost flow assumption. So it's going to be lower of cost or net realizable value. What is net realizable value? Net realizable value is how much the company would realize after selling it, right? So, but there is a cost to distribute here, 19. Okay, so now the net realizable value would be 217 minus 19, which is equal to 198, which is equal to 198. This is NRV. What is cost? Cost is the historical cost, which is 210. What is LCNRV? LCNRV is the lower of cost or net realizable value, now which is lower. 198 is lower. So you would be valuing the inventory at 198. You are not going to hold the inventory at 210. So what we would do, we would pass an entry to recognize this. So it would be debit inventory loss, you can say, or you can say loss due to LCNRV. You can debit any loss account, or you can also debit cost of goods sold directly. But I would prefer that you show it as a separate account so that you would know immediately that this is the write down of inventory. So how much are we going to write it down? It's 210. We have to write it down to 198. So 210 minus 198, we are going to write it down by 12. You're carrying it at the moment at 210. So you have to write it down to 198. And you will credit LCNRV allowance, which is a contra asset, which acts like bad and doubtful debts, right? So in the balance sheet, for example, in the balance sheet, the cameras would be held at original cost, which is this, and the LCNRV allowance would be 12, and the carrying value would be 198. So this is the end result of this. So why are we doing this? So that we don't want to hold inventory at higher cost, right? So we have to adjust it to the lower of cost, historical cost, or the market. So why? You see, in future, when we sell the inventory, suppose we don't make this adjustment and we sell the inventory, probably you would get in the future only 198, right? You might get only 198. So you would make a loss when you sell it. So instead of making a loss when you sell it, in fact, you're postponing recognizing the loss if you want to recognize it at the time of sale, because you might sell it next year or the year after that, or you don't know when, okay? So instead of recognizing the loss in future, US GAAP requires us to recognize the loss right now and show any fall in inventory value, so that at any point of time, the balance sheet is not overstated, right? The inventory in the balance sheet is not overstated, or for that matter, any asset in the balance sheet is not overstated. US GAAP is very particular about that. Okay, now, this, if FIFO, weighted average, or any other method is followed other than LIFO or retail, we use LCNRV, which I just now demonstrated. Now, let us go back to the original question where it says LIFO cost flow assumption. If the company has been following LIFO, it's going to be lower of cost or market. Now, this is a little complicated. It would seem a little complicated in the beginning, but the questions in the exams are going to be very straightforward. So in the case of LCM, we establish a maximum limit, which is called the ceiling. And this ceiling is the NRV, right? And so even if the inventory value goes above the NRV, we are going to value it at the NRV. And then the floor. The floor is NRV minus a profit, normal profit. So what is NRV here? We found out. Let us do it for cameras. So NRV here is 198. And NRV minus profit is 198 minus the normal profit margin, which is 32. So this would be the floor. So 198 minus 32 is the floor, which is 166. Now we have established the upper and lower limits. Now the replacement value is considered to be the market. We would test it whether it is above the ceiling. Yes, it happens to be above the ceiling. Okay. And the floor, it's not below the floor. Okay, so it's above the ceiling. So when it's above the ceiling like this, if it's more than the ceiling is considered to be the market. So the market is the ceiling, which is equal to 198. We don't take 203 as the market here because it's above, right? So we are going to write it down to 198 maximum. And then we would compare this with the cost. The cost is 210. The cost is 210. So the LCM is lower of cost or market. Now market is established at 198. Right? So the lower of cost of market is 198 because the market is lower and an adjustment has to be done for $12 like we did before. But here we would call it loss due to LCM. Debit LCM loss 12 and credit LCM allowance 12. And as I showed you before in the balance sheet, the camera would be at 210. The LCM loss allowance would be a contra asset, which is 12, and the carrying value would be 198. Right? So now, in case, just let us assume that instead of 203, if the replacement value was 150, instead of 203, let us assume that the replacement value instead of 203, it was, let us say, 150. Then what would have been it? We will check. Is 150 more than 198? No. Is it below 166? Yes, it falls below 166. Right? So in that case, the floor is the market. So you'll be comparing the cost, which is 210, with the market, which is the floor, and take the lower of the two. So your LCM would be 150, lower of cost of market. So there's a lot to write down here. So you'll be writing down 60, 210 minus 150, 60 would be the write down. So debit LCM loss 60, credit LCM allowance. Now let us take one more instance. I'll remove this. Let us assume the replacement cost is 170. Is 170 greater than 198? No. Is it below 166? No. So it lies in the corridor. So in this case, the replacement cost itself will be the market, not the ceiling or the floor. If replacement cost is in between the ceiling and the floor, if it falls in between the ceiling and the floor, then the replacement cost is the market. So it's here, market will be 170, cost will be 210, the historical cost. LCM, the lower of cost of market, will be 170, and we have to make an adjustment of 40. So that is how this works. Now, let us get back to the question, what they have asked us. So yes, now I would suggest that you try it out yourself. LIFO cost assumption, you have to value tripods. Right? So as per the LIFO cost assumption, the historical cost is 53. Right? Now, since it's LIFO, you have to follow the LCM subject to ceiling and the floor. The ceiling, as I told you, is the NRV. The floor, the lower limits are NRV minus a normal profit. So NRV here is 73.75, the selling price minus something to cost to distribute or to or further process it. In this case, the cost to distribute 73.75 minus 2.5 would give us 71.25. That is the ceiling. The floor is the NRV minus a normal profit, which is equal to 21.25, the normal profit, which gives us 50. Now you take the replacement cost, which is actually the market, but it's subject to ceiling and the floor. Is it above 751? I mean, is it above 71.25? Answer is no. Is it below 50? No, it is in the corridor. So then the replacement cost is equal to 51, which is equal to the market. So market is 51. Cost, which is the historical cost, which is 53. LCM is 51. So that's what they're asking us. LCM is 51. And yes, we have to make a 2 adjustment. So we would debit a loss account, debit LCM loss, which hits the income statement, 2, and credit LCM allowance, which is 2. And then in the balance sheet, you'd be carrying the tripods at original cost 53 minus LCM allowance. So contra asset 2, and you will carry it at 51. So the value that has to be used for tripods is 51. So this is not overstating your inventories. You're recognizing the loss right now. So this is about it. These are the concepts. I would suggest that you try out LENS. Try out both the LCM and the LCNRV. LCNRV is very easy. And also I have to mention here that in IFRS, it's always LCNRV, lower of cost or net realizable value. But in US GAAP, since LIFO is allowed, if LIFO or retail are followed, then it would be lower of cost of market, subject to ceiling and floor, like I've shown you now. US GAAP is more rule-based. and IFRS is more principle based. So there are more rules to be followed here. IFRS is a little lenient because it's a global standard. It's not only meant for US companies. So taking into consideration the culture, the business culture and environment of several countries, they do not fix very hard rules. It's very flexible. But US GAAP has more rules which has to be strictly followed in order for the company to actually raise finance in the US, a public limited company in the US. So yes, we have finished the concepts of LCM and LCNRV. Let us do some more questions in the next session. Hello everyone, welcome to the class on inventory valuation. So let us continue the discussion from the previous session where I explained the LCM and the LCNRV concept. Now, we also did a multiple choice question on that. I demonstrated it. Now, I'm going to show you the same question, but ask you a different question. It's the same data though, but I'm going to ask you a different question here. Okay. In fact, the question itself is different here. Okay, so now, in this particular question, they want you to determine the value of lenses. The value of lenses. We already did tripods and camera. So now they want lenses. Okay, so they want lenses, but I want you to pay attention. We shouldn't be adopting the LCM approach because it's a FIFO cost flow assumption. As I mentioned earlier, if it is FIFO, it should be LCNRV, lower of cost or net realizable value. Now, for this matter, we don't have to put the ceiling or the floor here. What we should do is just compare the cost with the net realizable value. So what is the net realizable value? The net realizable value is 145 minus 8, which is 137. So the NRV is 145 minus 8, which is 137. And the cost is the historical cost, which is 110. 110. And the lower of cost or net realizable value is 110. So B is the right answer and no adjustment is required at all. No adjustment is required at all. Right? Now, if I change this instead of FIFO, if I change it to LIFO, if the company had used a LIFO cost flow assumption, then LCM would have been adopted. Let us try that also out. Okay. So now for the LCM, we have to establish a ceiling and a floor. The ceiling is the NRV. We have already determined that to be 137. Here it is. And the floor is 137, the NRV, minus the normal profit margin, which is 29. 137 minus 29 is 108. Now we take the replacement cost, which is the market actually. The replacement cost is 109, and we are going to test it. Whether it's above 137, no. Whether it's below 108, no. It lies in the corridor. So the market here is 109, the replacement cost. If the replacement cost was more than the ceiling would have been the market. Had it been below the floor like 106 or 107, then 108 the floor would have been the market. Since it lies in between the ceiling and the floor, the replacement cost itself is the market, and you would compare it with the historical cost, which is 110. In this case, the LCM is equal to 109, lower of cost of market, and a $1 adjustment has to be made. In the case of FIFO and LCNRV, no adjustment is required because LCNR is 110, you're carrying it at 110, so you don't have to create any allowance for it. And this, if even IFRS was adopted, it would have been LCNRV. So this is how we should understand the entire concept of LCNRV and LCM. I would suggest that you practice more questions on LCM because LCNRV is relatively very easy, but you should watch out in a question, whether it's FIFO or LIFO. In fact, in this question, he just puts FIFO, but he doesn't say whether you should adapt LCM or LCNRV. So you should be knowing that. You should already know that if it's FIFO, weighted average, or any other method other than LIFO or retail, LCNRV is adopted. If it is LIFO or retail, LCM is adopted. So with that, we finish the valuation of inventory. You would do more questions from the question bank and come to me if you have any question, any problem in solving the question. I'm always available to you during office hours, or even if office hours is not convenient to you, we can agree on a mutual time and to answer your questions. Hello everyone, welcome to another lesson on inventories. And in today's class, we will be talking about reversal of write-downs and how they would affect the financial statements both under US GAAP and IFRS. Just let me take you to the text and explain the concept. So about write-downs, suppose in US GAAP, as they have mentioned in the note here, under US GAAP, recording inventory recoveries in value to the extent of previously recognized losses is limited to reporting within a single fiscal year. What does this mean? It means that if you have written down an inventory using LCM or LCNRV, and you are expecting it to reverse, if you are expecting it to be restored or reversed before the end of the fiscal year, then you don't have to record such a decline in inventory. And even if you have recorded such a decline in inventory within the same fiscal year, and it gets reversed before the year end, you can reverse it under US GAAP. You can restore the inventory to the original cost if it is within a single reporting period. However, under US GAAP, inventory write-downs reported on an annual financial statement. That means if you have recorded an inventory write-down either by using LCNRV or LCM, which I have explained in the previous session, it may not be restored or reversed in a later annual period. That means under US GAAP, once you have written it down for the annual period, for the annual financial statement, you cannot reverse or restore it in a later annual period. So it is sort of permanent. However, in IFRS, you can reverse it. So first of all, you should note that in IFRS, all inventory, you see he has boldfaced the all, will be valued at lower of cost or net realizable value. That is LCNRV. In US GAAP, if you remember, If it is LIFO retail, it will be LCM. And if it is other than LIFO retail method cost flow assumption, it will be LCNRV. But here in IFRS, all inventories would be recorded at lower of cost or net realizable value. Right? Then, what is the other difference? Under IFRS, previous write-down of inventories can be reversed, but it can be reversed up to the original cost, up to the amount which was written down before, not more than that, right? So gains cannot be reversed on on appreciated inventory, but previous losses can be reversed. Reversals of previous inventory write-downs in an annual financial statement is not permitted in a later annual period under US GAAP. But however, under IFRS, it can be reversed. Okay, but gains cannot be recognized on appreciated inventory. Suppose an inventory item was originally recorded at, let us say, 200,000. And later it goes up in value to 250,000. So now this gain cannot be recognized either in IFRS or US GAAP. However, previously written down losses, right? Suppose you have written down your inventory under IFRS, because IFRS, you will write it down to lower of cost and net realizable value. So, and in the next annual period, if it gains value, it can be restored, it can be reversed in IFRS up to the original cost, not more than that. So in other words, suppose a 200,000 inventory was written down to 175,000. And later on in the next period, it goes up to 250,000. You can actually write it up, reverse it up to the original cost, that is 25,000. You will not reverse it up to, you will not record a gain more than that. So a previously recorded loss can be restored under IFRS. But in US GAAP, it cannot be restored unless it happens within the same accounting period, right? So write-downs in interim financial statements may be reversed up to the original cost in US GAAP. I hope that concept is very clear now. So based on that, we can do a question. Let us do it in the next session. Hello, everyone. So in this lesson, we will talk about reversals of write-downs in US GAAP and IFRS. In fact, I have explained that concept in the previous session. So in this session, we will do a multiple choice question relating to this concept. So let me share the screen. So this is the question. Please pause the recording and try to solve it yourself. So it says a multinational company maintains its financial records under both IFRS and US GAAP. It's a multinational company. So maybe some countries would require IFRS and some countries would require US GAAP. So last year, the company determined its inventory with a carrying amount of 500,000 was impaired because of the demand of its product collapsed when a competitor launched a new product with innovative features. So because of the competitor's new product, this company's inventory was completely obsolete. As a result, the company wrote down its inventory to zero. So entire amount was written down, okay, because it was worth zero. This year, however, government authorities unexpectedly announced the competitor's product was defective and the product was removed from the market. So when the competitor's product is removed from the market, the company's product gained value. And its estimated net realizable value was 750,000 at the end of the current quarter. How should a company record this new development in the current quarter? So now a reversal is required. A reversal is required. And it was written down in the previous financial year under US GAAP. It is not an interim adjustment in the previous financial year, and it has gained value in the next financial year. So under IFRS, you can reverse this. So the answer A, the choice A is saying that under IFRS, zero write-up of inventory is not correct. You can write it up. In US GAAP, zero write-up of inventory is correct. So under IFRS, a 500,000 write-up of inventory is correct because you cannot write it up to 750,000 from zero. You can write it up to the amount which was written down previously. So up to the original cost, you can write it up under IFRS only. Under US GAAP, once written down, it's permanent, especially when it happens in a previous financial year. If it happens within the financial year, you can write it up to the original cost even under US GAAP. But since it happened in a previous financial year, zero write-up. So this is the correct answer. So the remaining is obviously wrong. You cannot write it up to 750,000. However, this part is correct. Under IFRS, you cannot write it up to this. Under US GAAP also, you will not write it down. It is permanent, especially if it is in a previous financial year. So B is the right answer. I hope with this question, you got the concept of reversals of write-down of inventories under both US GAAP and IFRS. And one more major difference between US GAAP and IFRS is IFRS does not allow LIFO, cost flow assumption. It's prohibited. US GAAP allows it with restrictions. What is the restrictions? That once LIFO is used for tax purposes, it should be also used for financial reporting. Another thing is, under IFRS regulations, LIFO cannot be used with LCM, that is lower of cost of market. So IFRS would not allow such write-downs. So that's what it would place some restrictions. Otherwise, you can use LIFO under US GAAP within these boundaries. So with that, we finished all about write-downs, reversals, and the recording of write-downs. Everything was discussed. In the next class, we would speak about errors in inventory. Hello all. In this session, we'll talk about physical count of inventories. So let me just take you to the text. So here, US GAAP. First, I would like you to read the note there, which is very important. So it says that physical count is required by US GAAP for annual reporting purpose. So you have to call it, you have to count the inventories at least once in a year, regardless of which inventory cost flow method like LIFO, FIFO, weighted average, or regardless of whether you're following the periodic inventory system in which account is a must, or if you're following the perpetual inventory system. Even if we are following the perpetual inventory system, a physical count is required for annual reporting purpose, right? So, and that should be matched with the accounting records. Physical count is, however, not required for interim financial statements when you're publishing the financial statements in the middle of the year, right? So what happens if you find a shortage? Supposing your accounting record accounting record shows, let us say 10 units, right? And physically, once you do the count, you find only 8 units. So there has been an inventory loss. So you would debit inventory loss 10 units and put the value depending on which inventory cost flow assumption you're following, right? So that would determine the value. So let us say this 10 units is $1,000. So you debit inventory loss 1,000 and credit inventory, remove it from the inventory after investigation. And if it's not being able to, traceable, we can remove it from the inventory and debit inventory loss for that amount. So that would be the correction. Sometimes it happens the other way about. Supposing there are 8 units and physically we found 10 units. There might be many reasons for this. Maybe the supplier sent the inventory twice, or maybe a sale was recorded, but inventory has not gone out. So in such a case, you would debit inventory for those extra 2 units, place the value based on LIFO, FIFO weighted average, let us say 500, just as an example, and inventory gain is recorded. So this part would go to the income statement. This part would go to the balance sheet. So here also the gain would be for $500. So this is how you would record inventory loss or gain due to a physical count. Now let us talk about errors in inventory. Now errors in inventory also would take place. Sometimes, you must be very familiar with this formula, opening inventory. To that, you add purchases. Then you would get available for sale, the units available for sale, and less the closing or ending inventory. I'll put there, ending inventory is a better term. Okay, and here also beginning inventory is a better term, right? And if you do that, you should get your COGS. Now, for example, let us say this is 100 units. We'll talk about units at the moment. 100 units. You purchased 200 units. You have available to sell 300 units. But once you have done the count and find that the ending inventory is only 100 units, you should have had 300, you have only 100. So what does it mean? You have sold 200 units, right? So COGS 200 units with the values, with the dollar values, you would get it, right? However, if we do some mistake here, right? So for example, if we overstated or by mistake, we counted more of the ending inventory. So then what happens? This remains the same, available for sale. Now cost of goods sold would be recorded at 150 units, lesser than previous. So the amount, the dollar amount also would be less. The dollar amount also would be less for COGS, and the profit, the gross profit and the reported income would be higher, right? And sometimes the other way about also could happen. You might have recorded instead of 100 units, you record only 50 units, in which case 250 units would be the cost of goods sold, and that would increase the cost of goods sold and bring down the profit. So all these effects would happen, and let us study these effects with the help of a multiple choice question. Hello, everyone. So in this inventory lesson, we would talk about errors in inventory. So I explained the concept in the previous video. Now we would do a multiple choice question and I would explain the concept further. So let us go and look at the question bank. So you can pause your recording, try to solve it yourself, and then look at my explanation. So here he says that during the year one, year-end physical inventory count at a particular company, 40,000 worth of inventory was counted twice. So year end, so it is the ending inventory which was overstated. Assuming the year two end inventory was correct. So year one was counted twice, year two was correct. The result of the year one error was that what happened? So that's what we should see. There are several choices. Now, my technique of doing this is as following. Let me just show you. In the previous video, I showed you that to arrive at the cost of goods sold, beginning inventory plus purchases less ending inventory. I'm sorry. Ending inventory. Now, beginning inventory plus purchases is available for sale goods. Less ending inventory would give us the COGS. Right? So now, if there is no error, I would put it as 0. So there was no error in the beginning inventory, so it's 0. There was no error in purchases. The ending inventory was counted twice. So 40,000 has become 80,000. 40,000 has become 80,000. So in fact, I would not put 80,000. I would put 40,000 because that is the error which happened. Right? Because 40,000 was counted twice. So the error is 40,000 here. So I put that wherever it's counted twice, it was overstated by 40,000. So now, if you are going to do the formula, that is beginning plus purchases, 0 plus 0 minus 40 would give the COGS as minus 40. COGS would be equal to minus 40. Right? Right. So then your profit would have gone up by 40 because your COGS, which is an expense, is understated. This happened in year one. Right? Year one, this is what happened. So let us see the choice one. Year one retained earnings was understated. No. In fact, if year one, if this is going to year one, this profit, it's actually overstated. And year two ending inventory was correct. So that part is correct. So let us continue with year two and then check the results. So now the ending inventory of year one would cause the beginning inventory of year two to be overstated. Purchases was correct, ending inventory was correct. Now, if you apply the formula to arrive at the cost of goods sold, beginning inventory plus 40 plus 0 minus 0 would give you a COGS of plus 40 because ending inventory is correct. So if there's no error, I'm putting it as 0. So now what happens? The profit will be understated because an expense is overstated. COGS is overstated. Retained earnings would give you the sum of these two at the end of year two because it's cumulative profits basically. So retained earnings would be 0 in year two. Right? So year one retained earnings was understated is wrong. Year one retained earnings was overstated because this profit would go to retained earnings. Year one cost of goods sold was overstated, which is wrong. Year one cost of goods sold was understated. We just no need of looking at the other half. We would just cross it out. Year one income was overstated. That is correct. Right? Year one income was overstated. And ending inventory and year two ending inventory was overstated. No. Year two ending inventory was correct. So that part is wrong. So it has to be D. We eliminated the other three. So year one cost of goods sold was understated. Yes, you can see a minus 40 there. So it's understated. And year two retained earnings was correct because it's self-correcting. The plus 40 and minus 40 cancel out, and the error in retained earnings is 0. Right? So nothing. See here, what I'm doing here is I'm just putting the overstated or understated amounts. Okay. So retained earnings, if it shows 0, that means it has no overstated or understated amount. The error is 0. So retained earnings for year 2 is correct because it's cumulative. It's self-correcting. First year it was plus 40 and second year it's minus 40. So cumulative figure would actually balance out. So D is the right answer. So this is my technique of solving this kind of questions. Now let us do a more tougher one, which is right here. I would suggest that you, as much as possible, try to do it yourself. It's not very frequently tested. Errors in inventory are not very frequently tested, but we never know. It can come anytime for the exam. So like I said, let us talk about year 1, year 2, and year 3. If there's an error, I'll put it there. Okay, so beginning inventory, sorry, I'll call it beginning inventory. Purchases less ending inventory. You'll get COGS, and then you will get the profit as well. Okay, so let us talk about beginning inventory. Year one, year-end inventory was overstated. So there is no error in the beginning, no error in the purchases. Ending inventory was overstated by 23. So beginning plus purchases, 0 plus 0 minus 23 would be equal to minus 23. COGS will be minus 23. Okay. And the reported profit is 161. I'm sorry. Reported income is 138. And this is overstated. If reported income is overstated because the COGS is understated, so what we do is the correct one should be minusing this 23. 138 minus 23. That is 115. That would be correct. See, because COGS is understated, this reported income of 138 is more. So we have to deduct 23 from that to arrive at the correct one. Okay, so it should have been 115. There are two answers, 115. So we can eliminate the rest. Okay, so now ending inventory of year 1, which is overstated, would make the year 2 beginning inventory overstated. Then what happened in year 2? Purchases, nothing happened. But year 2 ending inventory was understated. When it's understated, I'll put it as minus 61. Now, if you do the math, 23 plus 23 plus 0 and minus of minus. Okay, minus of minus 61 is plus 61. So 23 plus 0 plus 61. Because minus of minus. Okay. So that would become plus 61. So your COGS would be 23 plus 0 plus 61, which is 84. So COGS would be overstated by 84. You get a positive COGS. If the reported income was 254, the expense was overstated. So the income of 254 is actually understated. So you add 84 to that to make it correct. So that would make it 338. The expense 84 was overstated. So this reported 254 is understated. It's showing less. So you add this 84 to make it correct. So 338 is correct. Again, B and D shows 115 and 338. So you're forced to work out the next year. So the next year, the opening inventory is minus 61. It will be understated because the previous year ending inventory was understated. There was no error in purchases. The year-end ending inventory was again understated, but this time by 17. So if you are talking about cost of goods sold, minus 61 plus 0 minus of minus 17, which is plus 17. So if you do the math, 61 minus plus 0 and plus 17 would give us minus 44. That means COGS is understated by minus 44. The reported income of 168 would be more by 44. You have to minus 44 from 168 to bring it to the correct figure. So that would be 124. The answer is B. The answer is B. So this is how it's an easy way of solving this kind of questions. So if at all, if anything happens, anything comes for the exam, you can do it my method, or if you have a better method, carry on. The concept should be clear. That's what it's all about. With that, we finish this huge chapter of inventory. I also discussed the difference between IFRS and US GAAP, which is a must. You should be bilingual and know both the standards until one global standard is formed. So the next lesson after inventories is investment. We will do that in the next session. Hello, everyone. Welcome to the class on investments. So now this investment is when the company invests in either debt or equity instruments, how will the accounting be? So let me just explain it to you with the help of a chart for you to understand the overview of the investment accounting. Okay, so when a company invests in financial securities, they would either invest in debt instruments or equity instruments. So in other words, they might buy shares or bonds, right? So yes, so how do we account for this? If it is equity, I'll finish the equity side first and then come to debt. Okay, so if it is equity, first of all, okay, let me just put it here. I just hope that it fits in this page so that you will understand. So if it is equity, we test for significant influence. significant influence. Meaning that if the company holds 20% of or more on the investee company shares of the investee company shares, and can it exercise some influence on its operations, etc. So then it's said to be having significant influence. If it is yes, then the accounting would be equity method. I will explain this later on. If it is no, then there are two options. Is fair value determinable? Okay, fair value determinable. That means, is there a readily available fair value? In other words, are the shares quoted in the stock market? Okay, fair value determinable and fair value not determinable. Like for example, private limited companies. Fair value is not readily available there. Okay, so if fair value is determinable, okay, then it will be accounted at fair value. It will be accounted at fair value, and unrealized gains or losses. I'm using a lot of shortened forms here, so you have to pay attention to what I'm saying. So unrealized gains or losses would be accounted in net income. If fair value is not determinable, it will be accounted at cost. Okay, and then impairment losses and visible or observable price changes would be accounted in net income. So the price changes which can be observed clearly, you would recognize that in net income. So generally, where fair value is not determinable means that it's a private limited company. If fair value is determinable, there's a stock market for it. So prices are as per the stock market. So in a private limited company, one would account it at cost, what they've spent for it. And if there is clear indication of impairment, if the profits are dropping, if there is a strong competitor in the vicinity, or who has come up with a different product which has caused losses for the company. So wherever it's very clear that impairment has taken place, impairment is recognized in the income statement. It will be a loss, of course, so impairment loss would be recognized in the income statement. And what do they mean by observable price changes? It means that suppose a new partner has entered and that particular business partner has purchased shares from the company at a much higher rate. So that means there has been a price change which the others have accounted for at the time of their purchase. So if somebody else comes in and he has paid a higher price, that means the share price has gone up, and that is clearly visible. And the company, if they have invested in such an instrument, would account it for that price change. All unrealized gains and losses would be to net income. Now, the major part here is the equity method.